Hello everyone, a very good morning to you all. Welcome to the second lecture of Advanced Financial Management paper of ACCA. I hope all of you are doing well. If you have any queries from the previous lecture, please feel free to ask. Is there anything that you need help with? So what we will do is we'll start with a quick round of revision of what we had covered in the class yesterday. Okay. And we'll summarize it also in the class notes so that it can be referred later on as well. So, first of all, the chapter is role of a financial strategy. Okay. And within which we studied, okay, and what I'll do is I'll come to Excel and summarize this. So, what have we learned? That strategy, what is a strategy? It's a plan for achieving the long-term organizational goals. It can be of three types. Number one, corporate strategy. Corporate strategy. Number two is business strategy. Number three is operational strategy, right? These are the three things which we studied in the class yesterday. So, number one, two, and three. Okay. So that is number 1 point which we studied. Then it's from 1.1. Then next, what did we study? Next, we study what is financial management. What is the ultimate goal of financial management? It is to achieve financial goals through effective utilization and management of financial resources. So that's the summary of the second part. Goal of financial management objective is to achieve financial goals through effective utilization and management of financial resources. And they can be of, that can be done through three types of decision. So types of decision is number one, okay, so investment decision, and which we will all be studying later on in the classes. Investment decision, risk management, and all of these investment financing, dividend, and risk management. These are the four types of components which we understood about financial management. Okay. Then coming to the next part, it is about what type of objectives are set under corporate objectives. I think that can be skipped from the summary point of view. It was very simple that the objective is to maximize the profit of the company. Then next very important topic, which I said, is maximization of shareholder wealth and how it is done. So wealth maximization. Maximization of shareholder wealth, very, very important to be kept in mind always. So what is maximization of shareholder wealth? That is done through capital gain yield, and it is done through dividend yield, right? What is capital gain yield? Increase in the appreciation in share price and dividend on stock, right? So that is what wealth of the shareholder means. That's what we learned. Then we learned about communication to the stakeholders. Communication to stakeholders, again, pretty simple. It mentioned about what needs to be considered when you are communicating with the stakeholders, right? It could be whether they are internal, external, where they are in the power and interest hierarchy, what is the purpose of the communication, and appropriate medium. Okay, so putting it quickly. The stakeholders. So that would be following factors are considered. Following factors are considered. Internal versus external. We learned about the classification of what is internal versus external. Then where they are in the power and interest metrics, whether they have high interest and high power. That is what you need to consider. Then next is communication purpose. What is the reason that we are communicating? Is it because of some operational reason, or it's like a formal communication which needs to be done? So communication purpose and appropriate medium needs to be considered while you are communicating with the stakeholders, right? So this is the quick summary of communication to stakeholders. Then we learned about agency theory in the class. So what is agency theory? Agency theory, very important again from topic point of view. It is about the relationship between different stakeholders, okay? That there could be conflicts, okay? Agency theory doesn't mean conflicts. It studies the conflicts which arise between shareholders, directors, right? And directors, employees. So studies the theory, studies the conflicts which can arise between. What do we learn about agency theory? It studies conflicts between shareholders, directors, right? Then directors and employees. So that can be the relationship, any type of relationship, creditors and or debt providers and shareholders. So these types of conflicts can arise while they are working. Okay. Yes, principal being the shareholders and directors being the agents. Absolutely right. Okay, so that is the relationship between the different stakeholders. Okay. The next important bit which we studied was about the corporate governance. What is corporate governance? So, corporate governance, very, very important term. It means that the directors should act in the best interest of the shareholders. So it is a way of directing and controlling companies. Okay, that's what you need to remember about corporate governance. Yes, how would company work? Correct. That is corporate governance. Absolutely right. Now, and then something which we need to cover. Then we talked about goal congruence. Goal congruence. So, ensuring that the goals of the organization and those of, the different stakeholders, they are aligned in the best interests of the company. That is something which you need to carry forward from here. That is what goal congruence is. Okay. And how can it be encouraged? Okay. Methods of encouraging goal congruence include, very important. Number one is ESOPs. We discussed it in length yesterday. How can ESOPs help in goal congruence between directors and those of the shareholders? Then long-term incentive plans. So the focus of these incentive plans is the long-term growth of the company's performance. Then transparency in corporate reporting. So when the reporting is being done transparently, there is limited option to do some sort of, manipulations to just show that there is, goal congruence. Rather than that, there is actual goal congruence if there is openness in reporting practices. Then how can you improve goal congruence? It is through improving the corporate governance. And lastly, through increased shareholder activism. What does it mean? That you ensure that the shareholders participate in the decision-making process. There is more and more attendance in the meetings which are done to take important key decisions for the company. Okay, so this is what we learned under goal congruence. All right. Then we learned about the ethical behavior which is expected out of the finance advisors. Okay. Correct. That is what the objective is, so that the shareholders understand that their money is being utilized in the best possible manner. Now, ethical context, when you are working as the finance executive or advisor of a company. Very important topic. We discussed it in length again. Ethical context for the financial executive. So you need to understand it in different aspects. So ethically, you have to act with the profession, with the employer, with the clients. Okay. So with the profession, that is the proper use of the ACCA designation. With the employer is when you are obtaining proper consent to work with the competitors, if you are, changing your job. And then, with clients also, you need to act ethically. So no sort of, judgmental bias should come in. That is what we learned about under the ethical context for finance executives. And also, very, very important topic, which I said, is the compliance with the anti-money laundering. Compliance with AML legislation. So very important. What do you understand by AML? It is to launder black money into white money so that it can be put into normal use. So that is to be done by the finance executive, because ultimately money would be under your control as a finance manager. So this is something which you need to do. Correct? Next. Ta-ta. I guess pretty much this summarizes the entire discussion which we had yesterday. I didn't get you, Jay. What is PISOP? Okay. So I've put it here in the notes sheet. Now coming back to the book. We had done it in here in the first class. Oh, you're talking about that? Yes. So you have to exercise these attributes, but not covered in these lens. That's more from the audit point of view. But overall, you need to act in ethical way. So yes, it gets covered over here. What you say. And Jay, I think you were not there in the last class. I requested everyone to reply to everyone. So rather than replying to me specifically, you can just choose to reply to everyone so that everyone else can also read your messages. Okay. All right. Now let's begin a new topic from today's class, and that is the different models which can be used to describe moral and ethical decision making. They include the following three models. Number one is REST four component model. Then number two is always ethical development model. And three is IASB ethics education framework. So now let us cover each one of them in quick summary only. So the REST model, it is as follows. Step one, that it must be recognized that there is a moral issue involved. See, what are we studying? That whenever there is an ethical conflict that you are facing as a finance manager, how should you react? So it must be recognized that there is a moral issue involved. The decision maker must be able to appreciate that the selection of a particular course of action will affect the welfare of other interested parties. Okay, that means the action which is being taken by the decision maker is not in the best interest currently. So that has to be recognized as part of step one. Step two is the decision maker must be able to select an appropriate action which does not, or which resolves the moral issue. Okay. How will he do that? Step three, the decision maker must attach priority to moral values rather than, for example, acting out of self-interest. So the moral issues have to be given priority rather than the self-interest of any decision maker. See, step one is when you're recognizing that there is a moral issue, that you're not acting in the best interest of all the interested parties. Step two is then you identify the appropriate action. Step three is the decision maker must attach priority to moral values. And step four is the decision maker must have sufficient moral strength to implement the resolution identified in the previous step. So initially, the decision was getting guided by the self-interest. But now, once the model has been adopted and you have recognized that there is an action which you're taking, which is not in the best interest of everyone, then you need to have that moral strength to follow the corrective action that you have identified in step number two. Here's a very simple model. REST model, it says these are the 4 steps which can be taken out to avoid a moral conflict or ethical conflict, or to resolve a moral issue which could arise. Very simple. Model number 2 is always ethical development model, EDM. It unfolds in 4 progressive levels again. So number 1 is personal ethical understanding. This is the foundation level. It recognizes the distinction between right and wrong and grasping basic principles of integrity and empathy. So similar to REST step 1, here also you are recognizing that what is right and what is wrong by following the principles of integrity and empathy. Then application of ethics to business situation. So what you're going to do is, this is the stage at which you're going to translate and apply ethical principles to the business context. So once you've identified what is right and wrong, and then you have some situation to correct, then you're going to apply the ethical principles to the business context. Okay. Step number 3 over here is ethical courage. You're going to find a lot of similarity between the two models. It requires individuals to cultivate ethical strength and moral conviction, especially in questionable situations. Because whenever you are in such a situation that there is a conflict around you, you need to have the courage to act on the corrective path. Okay, so ethical courage. And step number 4 is ethical leadership. It is building upon level 3. It says that ethical leaders inspire others to develop their own ethical awareness. So one is, yes, you are taking the corrective action yourself, and second is you are inspiring others also in the journey to act ethically. So this is the Aubrey's ethical development model. Okay, ethical courage, or not necessarily whistleblowing, Jay. It is more about having to take a tough stand when the time requires. Because whenever there is a conflict like this, an ethical conflict, then taking the corrective action is a very strong strong thing to do. So at that time, you need to show the courage that yes, this is the path of integrity, of discipline. You need to pursue it with whole heart and confidence. So that's what ethical courage is, but it may include, I'm not saying it won't, it may include whistleblowing as well. All right. Next model which we have here is IESP, Ethical Education Framework. Let me be very clear, nothing to memorize over here that you have to memorize the steps and then you'll have to repeat it in exam, nothing like that. Just know about the model, what the undercurrent is. Undercurrent is that both of the models which we have studied so far, it is to recognize what is right, what is wrong, and then to act in the correct way, on the correct alternative with whole courage. So third one is IASP Ethics Education Framework. The IASP is an independent standard setting board of the IFAC. That is the International Federation of Accountants. So the ethics education framework as developed by the IASP is a 4-stage, again, this is also a 4-stage continuum to be applied by all professional accountants throughout their careers. So these are the 4 steps which you need to apply in all your decision making in your career. Okay. So step number 1 is you need to enhance your ethics knowledge. Okay. Then you develop ethical sensitivity. Okay, that's yes. This is what so first step is that you learn about ethics. Then you need to show that you're sensitive towards applying ethics to the situations wherever they arise. Third is improving ethical judgment. So over time, you keep learning as to what is correct, what is wrong. It might so happen that although you might have acted with ethics in some of the situation, but it turned out to be the incorrect way. There could be better ways of learning. So you improve ethical judgment. And step number 4 is marinating ongoing commitment to ethical behavior. So you keep on imbibing more and more principles to apply in your professional journey. Okay. So ethical knowledge, obtaining and understanding of the fundamental theories and principles of ethics, virtues, and individual moral development. Okay. Ethical sensitivity is what? Applying the knowledge. So what you have gained, as I was saying, applying the knowledge of the work environment to enable ethical threats to be recognized. Then 3 is ethical judgment, applying knowledge and sensitivity. So step number 1 and step number 2, to form reasoned and well-informed decisions. So that is what you're taking judgment on the basis of what you have learned. And 4 is ethical behavior, which is continuous believing in, applying and acting on ethical principles. So you continuously, keep on imbibing these principles in your work culture. Is it clear so far? Any doubts? Please let me know. So, Jay, this is the publication which we are using in the classes of VGLD's own publication. It is completely based on the ACCA's syllabus guidelines given. Okay. So you would not need to consider any other notebook. The entire syllabus would get covered in the class itself through these notes which we are seeing, the book. All right. One second. So this is something which we have learned quickly. What have we learned? 3 tables, 3 frameworks which we need to know is REST, 4-component model. Again, simple. What did we learn over here? That if there is a moral issue involved, then you need to recognize that there is a corrective step to be taken. Then step 2 is that you need to be able to select what is the corrective step. Step number 3 is to attach priority to moral values, that you have to think from the point of view of acting morally. And step number 4 is that you have the moral strength to implement and maintain that decision. So that is REST model. Number 2 is always ethical development model, EDM. Here, again, similar steps. What we have learned is that you need to have the distinction between right and wrong. What is right and wrong in a particular situation? Then applying ethics to these situations. Third is having the courage to act on it and inspiring others to develop their own ethical awareness. Then we learned about the IASB ethics education framework. So 4 elements are there. Ethical knowledge. First is you learn about the ethical principles. Second is when you apply this to the work environment, you understand which ethical threats are there in the company. Then applying the knowledge and the sensitivity to take proper decision. And ethical behavior is when you continuously believe in applying and acting on these ethical principles. So that is something which has to be done. Now, professional accountants need to cultivate yeah. Excel will be provided to you. In fact, yesterday, all of this I've mentioned in the class. All of these things which are referring to in the class will be provided. So nothing doing. You don't have to spend time on writing or anything. Just focus on what is being discussed. No need to take notes. Everything will be shared. So professional accountants, they need to cultivate what? They need to cultivate 3 characteristics. Number 1, so this is like a summary of all the 3 models. Number 1, it is the ability to recognize ethical threats. You recognize the threats and issues effectively. Number 2 is awareness of ethical alternatives. So one, you recognize the ethical conflicts. Next is you understand what is the correct way of doing that particular activity. And third is understanding of stakeholder effects. That whatever action which you are taking, what impact it is going to have on the different stakeholders. So this is something which you need to understand. Okay, Gagan says couldn't attend the first class. Classes would be from Monday to Friday. Also, is it possible to know a date when classes would reach the completion? Thank you. Gagan, discussed yesterday, but I'll reiterate for you. The classes would be on Saturday and Sunday, 7 a.m. to 12 p.m. And the classes would be happening till 17th to 18th of August. Maximum may change by a day or 2 here and there, but the target is to complete the syllabus by 17th or 18th of August. Timing of the class would be Saturday, Sunday, 7 a.m. to 12 p.m. All right, coming back. So this is the summary. Developing these skills enhances professional judgment by applying theories, acknowledging social responsibilities, adhering to professional conduct codes, and utilizing the decision models which we have seen above. So then if you have to develop these skills which I've just mentioned, you need to adhere to the professional conduct codes which are given by the ACCA. Again, detailed discussion in the audit paper. This is just like a overall discussion of what is expected out of you when you are acting in the capacity of a finance manager of a company. So make sure whenever you are solving any question, you need to have a professional and ethical outlook to the situation. Whatever suggestions or alternatives that you're suggesting in your reports or in any of your answers, it should be ethically correct. Maybe if the question is telling about use of child labor in the supplier's organization just to save cost, then you need to come out and be very vocal about it, and that you need to set up strong ways of conduct, okay, with the supplier. And if he doesn't comply with it, then again, see, as I'm saying, understand the important calls, the strong calls that you have to take as a finance manager to act ethically. If the supplier is not obliging, that means he is not removing child labor, then you need to remove the supplier from your, business. You need to find alternative supplier, although it may be expensive, but yes, always remember that you have to act ethically. And these are strong business calls that you will need to take as a finance manager, because it is expected out of you that if you're a professional accountant, you will act in the best interest of all the stakeholders, including the society. All right. Now coming to the ethical decision-making models. In ethics, addressing two key issues is crucial. Number one is the right motive, that the intent is right. Why you are taking a certain action is very important. So identifying the corrective motive behind actions, and then you take the corrective action. So ethical decision-making models provide systematic analysis, ensuring clear judgment. 1 minute. Yeah. So, deciding on the appropriate course of action, it is to provide systematic analysis, ensuring clear judgment, transparent reasoning, and justifiable actions in resolving the ethical dilemmas. So, here we have a new model again, and that is the Tucker's 5-question model. I've discussed it here with an example, which you can see. We'll come to that. First, let's have a quick glance at what the Tucker's 5-question model is. So, it poses 5 questions for assessing the ethicality of a business decision. Affirmative answers. That means the answer to all these questions should be yes. Okay. So number one is, whenever you are taking a decision, is it profitable? So you can look at it from here. Is it profitable? Is it legal? Is it fair? Is it right? Is it sustainable? So these are the 5 questions which are asked when you are taking a decision in the view of ethics. Okay. So Tucker's model stimulates debate. So the questions are simple. We'll cover it with an example that would be better. So it stimulates debate on conflicting ethical approaches, stakeholder perspectives, and sustainability. So it is like an overall framework. It's not just looking at profitability, it is looking at different approaches and including sustainability, whether the decision is sustainable in the long run. It is particularly apt for organizational problems, fostering discussion. That means it encourages discussions over professional or individual situations. Okay. So, much. Then we'll have to go by the dictionary definition of fair and right. Normally, these words are used synonymously. But since you have asked, let's do some difference between fair and right. So even okay, let me just come. Again, as I said, words are used interchangeably. Being fair is being right to the people around you and for the situations present, and being right is being correct for everyone anytime. I mean, I'm not much of a difference which I can see, but I guess fine. Just use it interchangeably, nothing to deep dive over there. All right, coming back. So yes, the example for the Tucker's 5-question model. Flipkart, a major e-commerce platform, you all would be aware of this company. Flipkart, it collects vast amount of user data. So whenever you're shopping on Flipkart, it keeps on collecting data about you, and that is with all due permissions that you are giving to the company at the time of signing up for the app. So it collects vast amounts of user data to personalize shopping experience and target advertising. So whenever, this is a very big decision that the company is taking, that is collecting the user data. Now, under the Tucker's 5 model, it has to see whether these 5 questions, are they being answered? Is the decision the right thing to do? So question number 1 is it profitable? So when you are collecting the personal data of the customers, what you can do out of it, personalized ads and recommendations often increase revenue, but user privacy concerns could affect customer trust and sales. So when you are collecting the data from of the customers from the app, yes, you can use it to make personalized ads and recommendations, right? It will increase revenue. Okay, but again, you need to be aware that it might affect a certain group of customers who are not comfortable with the sharing of data. So they may not even consider shopping from your app. So both the aspects have to be considered, that yes, the data which you are collecting can be used for, doing personalized ads, but user privacy concerns could affect the trust and therefore your sales may not happen. Then is it legal? India's Personal Data Protection Bill outlines user rights and data sharing limitations impacting how Flipkart can collect and utilize customer data. So whatever permissions are taken, it is in line with the India's Personal Data Protection Bill. Okay, so the compliance of these laws have to be done while you are collecting the data. So is it legal? That is how they will have to evaluate. They will have to look at India's Personal Data Protection Bill. Okay. Price discrimination. No, no, no. Fair is not discrimination. Fair is being you are being equally available or the decision is equally feasible for all. And then right is, being right in the situation. Let's not get into this it's a very trivial topic, unnecessary. Fair and right, please use it interchangeably, nothing doing over there. All right. Is it fair? Algorithms could create unequal user experience or price discrimination based on demographics and shopping habits, raising concerns about fairness and transparency. So, what you have to understand, is it fair in the way when we are looking at this particular question? Algorithms, they could create unequal user experience. And what I was saying is that the experience, they need to be equally available and at the dispense of the customers. There should not be any unfair way of picking and choosing the customers, that whose data is being collected and whose data is being not collected. So algorithms could create unequal user experience or price discrimination based on demographics and shopping habits, raising concerns about fairness and transparency. So it's being available and being whatever is being done equally for everyone involved. Now coming to, is it right? So one is fair. Now coming to rights, the ethical implications of manipulating user behavior through targeted advertisement and nudges should be considered, balancing market strategies with user autonomy. So fair is what we have done is that you are being equally considering all the customers. Now right is when you are you're not doing any sort of manipulations. The action which you have taken is in the right, whatever activities, there is nothing in what do I say, any wrong implication on any stakeholders. So the ethical implications of manipulating user behavior through targeted advertisement and nudges should be considered. So there is no type of manipulation. So there is nothing wrongdoing which is happening for the customers. Balancing marketing strategies with user autonomy. Okay. So ultimately, what it is about that you are taking under fairness a fair choice between the activities and the different stakeholders which are being considered for that particular decision. And is it right? What we can evaluate over here is that the action, it doesn't cause any harm to any particular customer. Okay. So the ethical implications of manipulating user behavior through targeted advertisement and nudges. It should be considered that there is no harm which is happening to the customer because of a particular decision that you are taking to collect data about them. Okay, there should not be any type of harm that is being caused. All right, then is it sustainable? So building trust and transparency into data collection and usage practices can create a more sustainable and ethical business model in the long run. So your data, whatever decision that you are taking, it should be sustainable in the long run. So for the long-term growth and development of the business. So the decisions should be seen in the limelight of long-term sustainability. Okay. So these are the 5 questions which are asked under this model. So let us do one thing. Let us in the normal parlance, we use fair and right interchangeably, but from the point of view of the model that we are talking about, Tucker's 5-question model. So under this, what do we have? We have 5 questions. Is it profitable? Is it legal? Is it fair? Is it right? Is it sustainable? Is it right? And is it sustainable? These are the 5 questions which are asked. And the objective is, why do we ask these questions? The question is asked for assessing the ethicality of a business decision, the following questions are asked, seeking yes. So if the answer to these questions is yes, then it is a good way or good decision. Okay, is it profitable? This is pretty simple. Is it legal? Okay, is it fair? So since there was a lot of confusion around this, let's capture it. Is it fair? It is equal impact on all the stakeholders. The decision. So equal impact on all the stakeholders of the decision, and no harm. How we can differentiate between them? There's no harm is caused to any of the stakeholders. I guess this will help you out. And then, is it sustainable? Everything which is fair can be right. Then yes, correct way of interpretation. So Vinod is saying, I'm reading aloud his message. Ideally, we can say that a thing can be right, but not fair. It may not be affecting all the stakeholders in the same manner. And everything fair is, again, here also when I'm saying it out loud, there can be situation. Is it fair? Meaning what? It has equal impact. Right is what? Having the right impact. That means what you're doing is right. So fair doesn't necessarily say that you have to be it has to be the correct thing to do. Is it fair? Meaning it is affecting all the stakeholders. So it is also possible that the decision that you're taking, it is fair, it is affecting all the stakeholders, but it may not be right. So it works both ways. What you're saying, the second statement, it can be, found out, there can be a way to prove it wrong, that yes, there can be a way and mean such that any decision which is fair, it may not be the right thing to do to the stakeholders. Okay. Is it sustainable? It is, meaning the long-term, long-term impact on environment and society. So this is something I've put it over here in Excel for a quick summary. Is it profitable? I'll just complete this. Is it legal? Govern, and complying. Yes, but again, just a respite that not necessarily you will really need to apply this. It's just from chapter one perspective when you are learning about finance management in general. So all of these are expected that you apply this. But once we start going into chapter two and three, it will all get money, money, money. But yes, jokes aside, take care of these things when you're drafting your answers, that your approach is ethical and it doesn't cause harm. See, ultimately, it's very simple. I can say that, consider just the impact of profitability. But like the example which I was giving you, the ethical dilemma that, use of child labor by a supplier of your organization, then what happens in a way? It is, you're saving on cost. So yes, it is profitable for you, but is it ethically right? Is it right? No, it is not right because it is causing harm to the stakeholders, right? So from that perspective, you will need to evaluate um, your decisions. Okay, coming back, yeah. So we covered this example. Now there's a question for you. Please do not look at the answers. Let's be fair. Let's be fair and right. Uh, your company owns a number of large hotels in various major cities of the UK. The real estate assessor in London offers for a fee to underestimate. What they're doing is to underestimate the value of your building. And so you will save substantial annual taxes assessed on property value. This is a common practice. Everyone is doing it. Okay. So you have to assess whether it is the right decision, taking into consideration the Tucker's model. Please do not look at the answer. Just think it in your head how you would assess this particular situation, keeping the Tucker's model in mind. Draft your answer. I'm giving you 3-4 minutes. Draft your answer and send it to me on chat box. I'll review and share my feedback on it. But please stick to the time. Don't take much. Draft a small short answer, 3-4 lines, how you would deal with it. Whether you will go ahead with the underestimation of the property value or okay. Quickly do it and share your answer when you're done. We'll go through your answers. So Utkarsh says, in my opinion, it is not right to underestimate the value of a building. It is not legal and can have repercussions in the future. Also, the fee start with assessor is not right. It is not sustainable if all people would start the same practice taxes given to the government would reduce, which could have been used for general public at large. Illegal practice, even if it is common, cannot be termed as ethical or correct. Very good closing statement. Good answer overall as well. Gagan says, is it profitable? Yes. Is it legal? It is not legal, correct. Is it fair? Though it would end up in increasing shareholders' wealth, but the same cannot be judged on the fair on long-term impact of the transaction would cause. Is it right? Going against the law is not right. Even though shareholders' wealth has increased, is it sustainable? If the council is not able to collect a full level of taxes, then the council would not be able to maintain the area, develop the area properly. So not sustainable. Concluding that the transaction fails the ethical check by applying the Tucker's model, and therefore the company should not proceed with the transaction. Very well drafted answer. Good one. Then Jay says, under assessment just for the cause of cost reduction. Tax reduction is not ethically correct. Profitability would impact if this activity is owned by the stakeholders due to reputational damage. This is not fair to the stakeholders and not even right as this is not approved by the government or it is the practice followed by other competitors. It's breach or may be non-compliance of regulation misleading the stakeholders. Jay would recommend making short sentences rather than very long sentences. It becomes difficult to follow. Write in short, crisp sentences. Your idea should come out properly. Okay, the answer which you have written is correct, but it's very difficult to follow. There is no formula for the Tucker's model. Your conclusion, it should be like the model expects affirmative answers to all the questions. And in the current scenario, it is not so. Rather than saying there is no affirmative answer because it is profitable, you can say it. So in that way, it is better to say that yes, it could that you're not getting an affirmative answer to all the questions under the model. All right. Reviewing the answer from Vinod, is it profitable? Yes, it is profitable. The organization will be saving a huge amount of taxes, but due to undervaluation can also get an impact on impairment. But the book value can save the balances. Not necessarily. This point is not correct. I'll tell you why, Vinod, because this is property assessment for paying of taxes. It doesn't really mean that you have to incorporate it in accounting books. So the point that you made is correct. First part is fine, but the correlation which you're making with the accounting books, that can be refuted. Is it legal? It appears to be case of malfeasance as providing a fees to undervalue eyes for the bribery and is a misconduct. This is fine. Is it fair? It doesn't appear to be fair. Though the industry is practicing the same, it's not appropriate for reporting to the stakeholders. Is it right? No, in the eyes of the profession, not right. Just to curb the legal angles and provide misinformation. Is it sustainable? It does appear to be sustainable. As this method, the organization has which is generally spent on vaccine, but once upon it can also be negative. Or you can say heavy penalties, because once caught, then there can be heavy penalties. So good question. Utkarsh says, now we know the model and then we are applying the model while drafting the answer. Do we really need to do that in exam as well? See, applying a model, it is definitely a plus point in exam. Okay. So you may not really use the model, but you still get marks. But if you are using the model, then you're, image in the mind of the examiner, it gets enhanced that yes, the person is able to correlate with the topics covered in the syllabus properly. So then that becomes like a positive thing. So you don't worry so much that by not applying the model, you will not get marks. You will get marks, but it is always better if a particular situation can be put in the context of a model, then it is always better to do so. Because there are not many models which you'll be learning in AFM. Practically speaking, there are not. See, if you were talking about APM, then I would have said you have to learn so many models. But in AFM, there are hardly any models. So if a question comes like this, it's better to put it in the structure of a model and then answer your question. Okay. All right. Coming to the solution now. Yep. Okay. This is a case of bribery since all 5 questions. See what I was telling you. Since all 5 questions in this model must be answered in the affirmative, the payment is not defensible as the evasion of tax is illegal. Okay. It is not fair to the wider society. It is illegal. It is not fair because it is not having an equal impact. What did I tell you about fairness? Fairness is that you treat every stakeholder equally. Okay. So is it equal treatment? No, it is not fair to the wider society that the burden of evaded tax should be borne by others in order to provide the services and facilities for which the tax is raised. A lot of you brought up this point, very well done. So that, if you're not collecting the taxes properly, then someone else will have to bear the brunt, because ultimately the upkeep of the, council area or the city has to be done. And if you are evading taxes, and what will happen? It will fall on someone other's pocket in some other form and manner. So nor can it be right. It is not right also. That it is not right that others should suffer a deterioration in or lack of services as a result of underfunding. So ultimately, you are, harming the society. What did I tell you? Righteousness is that you're not harming anyone. Okay. So would suggest, okay, sir, like while you were drafting the answer now, I just made small amends to this table. Just read this table when you are evaluating the question. Is it profitable? It is that you have to evaluate the financial implication. Is it legal? You are ensuring compliance with the laws. Is it fair? That we have understood equal treatment should be done to all the stakeholders, including, the society, community, whatever. Is it right? That means you have to check the alignment with the moral, ethical principles of the organization. So is it right to do so? Is it right to break the law? because ultimately it will harm other community, which is not, it doesn't go in line with the values of an organization. Is it sustainable? It is long-term impact on environment and society. So this summary you can refer to. Then Utkarsh says it is a type of preferential treatment which is being given to people agreeing to pay the fees. Hence, it cannot be considered as fair. Correct. Absolutely right. So where were we? It is not right. Others should suffer a deterioration in the services as a result of underfunding. That it is considered common practice. One of you wrote this statement. Very good remark. That just because it is common doesn't mean it is right. It is not advisable in that a vicious circle is created for increasing levies, which are increasingly evaded. The environment may be harmed. Okay. For example, vital services, example, the provision of clean water may be compromised if charges then have to be made for services such as waste disposal, because there are no taxes to fund the service. Environmentally damaging practices are likely to increase. So if everyone starts evading taxes, then there will not be money left for the activities for which the taxes are being raised, and that will lead to compromise in the quality, okay, which you would not want. So this is the answer. Okay, now you are right when you say that the expectation is that you are reporting to a senior leader. But I didn't understand the context of your question. Maybe that is the reason they don't want bookish answers. Correct me if I'm wrong. Yes, no one is expecting you to write bookish answers. More, the questions in the exam are like, there will be situation based. No one is going to ask you to replicate a model. So when you are, I think, is it because you have written this summary? You do not have to memorize this at all. One thing is very clear, don't have to memorize the models, but you need to be able to relate these points to the scenario given in the question. So there was a scenario given in this question also, that there is this tax evasion going on. So what did I do? Did I write down the points of the model? No, that's not expected. You are supposed to relate these points to the scenario and frame your answer. So you're right, absolutely right in what you are saying. No, there is no expectation of bookish answers, or there is no expectation of rote learning also. That's why I've been telling constantly, don't worry that, you have to memorize all of this. No, just get an understanding of what is the expectation, what is the attitude that is expected as a finance manager. Okay. Now, ACCA's ethical conflict resolution. You need to apply the ACCA's code of ethics. You should know the facts, identify the ethical issues, stick to fundamental principles, use established procedures, predict outcomes of actions. Simple, it's very simple language, so going with the flow. Think about alternative actions and consequences. Talk to others. So if you are not able to come to a conclusion, then you can talk to peers in the community. Talk to others. If needed, consult legal advice also, or from ACCA. And if the conflict persists, consider distancing yourself from the matter. Very important. Okay. So what is the ACCA's guide to resolving ethical problems? Know the facts, identify the issue, stick to the fundamental principles of ethics and morality, use established procedures, and then you predict what would be the outcome of this action. Think about alternative actions and consequences, talk to others, and if needed, consult legal advice or ACCA. And if the conflict still persists, then consider distancing yourself from the matter. Is it clear, everyone? So far, good. Any doubts? No doubts. Perfect. So now let's move ahead. So agency issues and stakeholder conflicts. Again, continuation of what we have studied earlier. Now, in a publicly traded company with a significant separation of ownership and control, that is the shareholders and the directors, because ultimately shareholders are the owners and directors are controlling the company. So, agency issues can notably influence the ethical framework. Directors and shareholders face differing ethical positions because of scrutiny of directors. Directors' ethical conduct is intensely scrutinized by the public and investigative journalists, risking serious damage to personal reputation in case of alleged wrongdoing. Shareholders' limited responsibility. Shareholders, being detached from the day-to-day operations, are less easily held responsible for any ethical lapses. Moreover, institutional investors holding the majority of shares have diversified portfolios across multiple companies, so they don't really are concerned about ethical uh, actions so much, because ultimately the control is in the hands of directors, but their actions are very closely scrutinized by the media. So, company directors and the entire workforce often adopt a cautious, sometimes even paranoid approach to ethics due to close linkage between their personal reputation and that of the company. See, what did we just study? That there is a close scrutiny of the director's action. So, they become extra cautious. So, in contrast, institutional investors may adopt a more relaxed stance. They'll be like, we are anyways distanced and we have investment in a diversified portfolio. So, as they are shielded from personal scrutiny and typically hold a diversified portfolio. Okay. So, now to address the ethical guideline pressure, if directors face pressure from shareholders to relax ethical guidelines, effective responses may include number one, quoting relevant legislation. See, what is happening is that the directors are under tremendous pressure to act ethically. Okay, so they are, because they are being closely scrutinized. So what they can ask is, since they are facing a lot of ethical guidance or guideline pressure, they may seek some ways to relax these guidelines from the shareholders. And how can they do so? Quoting relevant legislation. So citing applicable laws uh, with penalties for contravention, such as the Foreign Corrupt Practices Act for US registered companies, prohibiting bribes globally, and engaging ethical investment funds, encouraging ethical investment funds to invest in the company, aligning their ethical stance more closely with that of the directors. So, what is being said over here is what directors can do is they can make, so if the guidelines internally being followed with respect to ethics is very stringent, then the directors can tell the shareholders that yes, this is the legislation, this is the expectation of the legislation, and we are ready to comply with it. Internal regulations may be, it may be, relaxed a little. And then engaging ethical investment funds is that you're seeking investment from investment funds which are known to be ethical in their approach and investments. So you can seek investments from such firms, so that when you do so, it shows on your reputation that the decisions being taken by the directors would be ethically right. Only then the investment fund has come into them. So while shareholders hold a pivotal role, potential conflicts with the other groups should be acknowledged. So it's not just about the conflict between directors and shareholders. Conflicts with other stakeholders also need to be evaluated. Consumers may boycott products if manufactured in exploitative conditions, like I was telling you about use of child labor. Mitigation may involve subcontracting manufacturing, but reputational risk still remains. So if it comes out in the public that the outsourced contractor of your company is, applying some sort of manipulative or exploitative conditions in their factory, then it affects your reputation as well. So just because you have, subcontracted some of your operation, it doesn't relieve you of all the repercussions of unethical practices. Government scrutiny. Governments may act against businesses using aggressive tax avoidance. Recent examples include proposals to tackle promoters of such schemes, allowing authorities to petition the court to wind up companies engaged in tax avoidance. So, government is coming down heavily on tax evaders. They may even consider winding up your business. So, for avoiding ethical guidelines, um, you know, what have we learned basically? So there can be ways to relax the ethical compliance guidelines, but that can be discussed between the directors and the shareholders. But understand that conflicts are not to be resolved just between directors and shareholders, but they also have to see what is the impact on the customer, because ultimately customers are also very important stakeholders of a company. So if you are undertaking unethical practices, then the customers may also leave your hand. And government scrutiny is that when you are doing some unethical practices, then government can also come down heavily on you. Okay, so that is about the stakeholder conflict. Any doubt so far? Please take a look. Let me know if any topic that you want me to discuss again. Anything at all, let me know. All here, no? All right, perfect. So then let's move to the next part. Sustainability. So, what do you know about sustainability? It is the dynamic process aligning resource use, investments, technology, and institutions with current and future needs. So, in short, sustainability means acting in a way which doesn't leave the future generation deprived of something. So, your actions should be aligned in such a way that it has a positive impact on the present as well as the future. So the sustainability point, first is corporate sustainability. Business approach creating long-term shareholder value by addressing economic, environmental, and social opportunities and risks. So the approach of the business as a whole should be towards acting sustainably so that it creates long-term shareholder value. And corporate sustainability can be discussed under three headings. One is economic, environmental, and social opportunities. Okay. So you have to evaluate the decision from three perspectives. Economic is whether it is creating or whether it is having positive financial implication on the business. Environmental is your environment. And social opportunities, meaning the impact on the society. So sustainable development is what development meeting present needs without compromising the future generation's ability to meet their own needs. So very clear. I mean, I'm sure you would have read all of these definitions in class 5, 6 previous classes. So what is sustainable development? That you develop in such a way that there is no compromise on the future generation's ability to meet their own goals. So sustainable finance is what? We'll come to this. ESG investing, considering the ESG factors. Okay, ESG is what? Environment, social, and governance. Okay, so considering these factors in financial sector decisions for long-term investments in sustainable activities. So these are the key terms which you need to know before you start off this topic. So what is sustainable finance? Considering these factors in financial decisions so that the investments are happening in sustainable activities. Now let us talk about each one of these topics in detail. So sustainability, now we know it is aligning ensuring proper use of the resources so that there is no compromise on the ability of the future generations to meet their own needs. Now, examples of sustainable development include use of existing buildings instead of new construction. Rather than constructing new buildings, you may consider repairing and maintaining the old buildings or existing buildings. Building with eco-friendly designs. Very recently, I was reading an article whereby this company in some US, if I'm not wrong, they have developed it's being done very, in a lot of situations. That the walls of your premises are built in such a way that in case of excessive heat, they don't get heated up so much. So the use of ACs can come down. And similarly, in case of the extreme winters, the walls of the office premises are made in such a way that they do not get cool, or they absorb heat from the sun more, such that it is naturally heated rather than you have to use heating devices. Just because the way it has been designed, the office has been designed, you are able to save on electricity by through the use of heaters. So you'll not use or need the heaters any longer. Then the third example of sustainable development is minimizing impact on local residents. Yes. So minimizing impact on local residents, that means the negative impact that you are creating on the society, it should be as less as possible. Protect native plants and wildlife. Simple. Reduce waste and promote recycling. Shift to renewable energy like solar and wind. Control and clean up pollution. Develop on previously used sites, leaving untouched, undeveloped land. So if a particular land is untouched, you leave it untouched. Develop on previously used sites only, so that you're not causing any further damage to the environment. So ESG investing, very, very important topic. Very important topic, new topic in the syllabus. So ESG investing, it prioritizes ESG factors, environment, social, and governance factors and performance alongside profits, emphasizing a long-term outlook over short-term gains. So you need to have a long-term view in an organization to be sustainable. So it aims to balance financial returns. So, and financial returns, they are checked along with environmental and social responsibility, providing a more comprehensive risk analysis for informed decision making. So when you do an overall analysis, you're not just looking at profits, but you're looking at environmental, social impact of a particular decision. It becomes an all-rounded sustainable decision. So ESG criteria, very important. Please mark this topic as an important topic. Okay. So environmental, ESG criteria for the environment assesses an organization's environmental risks and impacts. So I'll tell you this example. Okay, we have already covered, we have examples of this, we'll come to it. So ESG criteria for environment assesses an organization's environmental risks and impacts. This includes climate change, water security, environmental health, waste management, and biodiversity loss. Interconnected environmental risks can be effectively managed with a proactive approach going beyond the minimum standards. So it's not like, you have to just bare minimum meet the standards. You have to go beyond it for your company to get that reputation that, yes, this company is doing well from the ESG criteria perspective. So organizations can enhance their ESG rating. See, organizations are being rated on the basis of their ESG contributions. So organizations can enhance their ESG ratings by taking actions that actively contribute to environmental improvement. Okay. There was a time when we used to have credit ratings. Now there is ESG ratings, because the customers, the investors, they are now becoming more and more aware, and they take cognizance of these things, that how is the company behaving? Is it sustainable in the long run? Okay. So business leaders who recognize the value of the physical environment and natural resources strategically pursue business practices that preserve the assets for future generations. Always remember, today's customer, they will prioritize environment over money. Because ultimately, everyone is realizing that, with the effects of global warming and everything that which you're seeing around you, artificial flooding, global warming, it all shows that already environment is in a very bad state, and active steps need to be taken to correct it. So for that reason, the customers today, they seek ESG ratings. Yes, they are called as green customers. Correct, Jay? So social ESG criteria focus on an organization's relationship with various stakeholders, aiming to enhance overall social well-being. This includes addressing peace, upholding human rights, and ensuring worker and community health and safety. So social criteria is that you look at the society as a whole. By fostering inclusive, fair, and positive operations, organizations contribute to thriving communities. Social criteria span from executive offices to the supply chain factories everywhere. It's not that any one particular division of the company has to cater to the society. It also happens at the top executive position, but it also happens at the lowest levels of management. It leverages employee policies, it makes the necessary changes in the employee policies because ultimately employees are also a part of the society only. So they leverage employee policies, benefits, due diligence, and supplier contracts to embed social values. Every company, every major company, MNCs, you would, if you're, working, you would already know that companies, make their suppliers sign on contracts. There are codes of conduct which are signed by the suppliers such that they will use ethical practices in their companies. See, I as a company, I'm telling my suppliers that, you have to act ethically, otherwise I'll not do business with you. So these are very important. Okay. So when you foster such an attitude, you create a good society. Then governance is the essence of governance, ESG criteria in business leadership, and transparency. This encompasses policies related to diverse board of directors, corporate accounting standards, executive compensation. So ultimately, you should have a diverse board. It should not be guided or discriminatory in any form, be it the gender, be it any ethnic race. Everyone should have an equal opportunity in governing. What is governing? Directing and controlling a company. So everyone should have an equal chance to be participating in the governance of the company. Okay. Accounting standards should be followed. Executive compensation, there should be a remuneration committee in the company which decides on the remuneration of the executives. Okay, when I say executive, the CXO positions. So public disclosure, conflicts of interest, and other legal and ethical matters. Governance extends to policies fostering meaning promoting organizational fairness through internal control systems, preventing illegal activities such as bribery and invasion. A lot of you, if you're working, you would have already signed ABC. What is ABC? Anti-bribery and corruption norms of a company. So that ensures that the company is working in an ethical way and every employee is complying with it. Correct? So now let's cover ESG with examples, all the different elements. Environment and sustainability, RIL. What does RIL do? Alongside renewable energy investments, if you follow business news and all, you would be knowing that there has been growing importance of companies engaged in renewable energy. In fact, consider it as a good, it's like a good thing that from the future perspective, these companies are going to grow for sure. It's a good sector to look at. So alongside renewable energy investments, RIL implements strong corporate governance practices like transparent reporting, independent board oversight, and stakeholder engagement. This ensures accountable and ethical decision making regarding environmental sustainability. So while they are, while they're investing in renewable energy, there is also a culture of transparent reporting within the company, and it ensures that the company is not just following environmental sustainability in words, but also in practice. Then Tata Motors, the transition to electrical vehicles. Okay, the transition to electrical vehicles at Tata Motors is accompanied by robust governance policies regarding data privacy, ethical sourcing. Ethical sourcing is very important, and responsible disposal of batteries. This ensures a holistic approach to sustainability. So you're thinking from the environment point of view, whether you're sourcing it from locations which are, ethical, or their approach of working is ethical. So this is a point which is taken care of at Tata Motors. Then comes social sustainability. We can talk about Godrej Group over here. Their good and green model, it integrates social responsibility with good governance initiatives like employee engagement programs. See, what did I tell you? Employees are also part of a society. And there are programs held to engage them further, to uplift their well-being. So initiatives like employee engagement programs, ethical supply chain management, and transparent reporting on social impact demonstrate their commitment to responsible practices. Their extensive meal program, for now coming to Akshay Patra, their extensive meal program relies on robust governance practices, including independent audits, donor engagement platforms, and risk management processes. This ensures efficient operation and ethical use of resources. So you would be knowing about Akshay Patra Foundation. So they feed some millions of children on a daily basis. So it's a meal program. Okay. So they are uplifting the society. See, what are we studying? We are just looking at examples. So, like social sustainability, how Godrej Group has done it through their employee welfare programs and all, through different social impacts which their policies are creating. And Akshay Patra Foundation, whose whole purpose is to feed the society. They also get audited. They also have engagement platforms for donors who come together and discuss their experience with the company. Then governance sustainability. Mahindra Mahindra, this leading auto manufacturer, established a good governance as a core value, implementing clear ethical policies, whistleblower mechanisms, and strong anti-corruption measures. This commitment fosters sustainable decision making and long-term business success. So, the business should be directed in the right way, and that is possible through having clear ethical policies, whistleblowing policies, okay, and strong anti-corruption measures. ITC, their triple bottom line approach, triple bottom line reporting, will come to that. So it's a topic over here, triple bottom line reporting, again, very important new topic in the syllabus. So their triple bottom line approach balances. So ITC reports using triple bottom line reporting. So their triple bottom line approach balances economic, environmental, and social responsibility with a strong focus on good governance. Their commitment to transparency, risk management, and stakeholder engagement reinforces their sustainability efforts. So they are focused in ensuring that the ways of working of the business are ethically right. They have a good governance structure within. So some factors defy. So this is fine. Okay, just so what have we learned? It's all about being ethical in the approach. Following the ESG criteria is very important. What is the ESG criteria? That is environmental, social, and governance. We need to know about each one of these three criteria. So what I've done now, I've put this slide here. It is taken from SBI Card's published statements, okay, for Q2 financial year 24. See, companies, they are actively publishing these things. It's not just a matter of theoretical discussion. Companies are actually adopting it. So you can see that on your screen. Yes, absolutely right, Jay. ESG audits are also done. That whether the company is complying with all the requirements properly or not. Absolutely right. So take a look at SBI Card's ESG reporting. So what are the reporting under environment? 5.72 lakh trees saved through paperless communication. Energy optimization. I hope you can see my screen as well. Higher efficient mechanism introduced in air handling units in corporate offices. So they are using better ways of energy. A CSR initiative to establish 10 TPD material recovery facility. That's the capacity of the plant, and 30 TPD plastic recycling facility and 40 aerobin composters in Patiala with Indian Pollution Control Association for strengthening the waste management system. See, just look at how SBI cards, it is contributing to the environment. How many trees saved by resorting to paperless communication, how they are, partnering up with the pollution board to strengthen the waste management system. See, look at how practically these companies are doing it. And if you are working in these companies, you also have to get involved in such activities, right? Yes, yes, yes. Now, coming to social, let's see what SBI card does from the social point of view. What new programs for employee welfare we covered, right? That employees would be they are an active part of the society. So there is webinar on sound healing for employees to enhance wellness. So having mental well-being, that's also very important considering people have been dealing with so much stress lately. So these programs, they help the employees to rejuvenate. Zumba sessions in our main head office, Gurugram, every week to promote fitness. So it's not just mental well-being, it is also physical well-being. Nutritionist consultation in-house for employees twice a month to support and promote awareness on healthy diets. Healthcare initiatives for communities. So this was for employees. Now, other than that, for communities, project taken up with Sri Satya Sai Health and Education Trust to set up mother and child hospital at Raivala to address the mortality and morbidity rate of children. So they are contributing towards the society by setting up hospitals. The next is governance. So governance is what? Directing and controlling the company in the right direction. So there is regular communication and training for all employees on ethical conduct. So what is ethically right? In fact, a lot of you would also be taking up these trainings. I know it's actually a little recorded sessions that you have to watch the trainings and you have to give tests and all. So that is what it is inculcating and ethical behavior in you. That's this is the expected, the right way of doing things. If someone is offering you bribe, then how do you tackle it? Whom do you report? So these things, they are regularly imparted. These trainings are regularly imparted to the employees. Mandatory annual training on improper payments for all employees. So this is with respect to SBI card in specific, since it's a payment and fintech company. Risk awareness week celebrated, sensitizing all employees on data protection, and overview session of the Digital Personal Data Protection Act conducted for the senior management team of SBI card. See, if you are training your employees well, then you can have that sense of satisfaction that yes, company will also be running in the right direction with respect to governance. I hope this example, it just illustrates that yes, it is very much practical to be adopting the ESG criteria at work. Is it clear, everyone? So consider this as an important topic. Make sure you're well versed with it. A lot of examples have been given over here. Please just let me know if it is fine. Can I move ahead? All right, perfect. Now comes again a very important topic, and that is the triple bottom line reporting. TBL, 3BL, different names for it. The term triple bottom line was coined by John Elkington. Again, no need to memorize names. It was coined by him, co-founder of Sustainability, a business consultancy. It serves as an expanded performance measure. Okay. Yeah. It aims to assess corporate performance against economic, social, and environmental benchmarks. Don't get confused. This is economic, social, and environmental benchmarks. ESG was environmental, social, and governance framework. Triple bottom line is economic, social, and environmental benchmarks. Please don't get confused. Allowing for improvement or more comprehensive evaluation. So you're not just reporting on profits, but you're also reporting performance against social and environmental benchmarks. If governance is included, so if you're including governance also, ultimately what is ESG? ESG is environmental, social, and governance. So you're already including social and environment already. If you're including governance also as a part of your reporting mechanism, it becomes quadruple bottom line reporting. So you're reporting under 4 heads: economic and ESG. So this concept can be seen as both a reporting device, often found in annual reports, and an approach to enhance decision-making and organizational activities. It provides tools and frameworks to consider the economic, social, and environmental implications of decisions, products, operations, and future plans. So ultimately, it is a way of reporting, nothing much. It is a way of reporting your contribution under the following categories, not needed from practical point of view, just from the theory point of view, that you should know that there is a concept of PBL, under which reporting, so often found in annual reports, an approach to enhance decision making and organizational activities. So, what are the advantages of this PBL? Let us understand that. Advantages as well as disadvantages. So, advantages is, again, such a great level of transparency that you're bifurcating your performance into 3 or 4 categories. So, it reveals decisions explicitly, considering environmental and social impacts alongside financial considerations. So, you're not just reporting on financial aspects, but you're also reporting on environmental and social impacts of the decisions, which is very crucial. Informed decision making. It enables decision makers to quantify trade-offs between various sustainability aspects, aiding more informed choices. So what it is trying to say, let me simplify it for you. Say, ultimately, every decision that you take, I'll give an example. So I'm sure you would be knowing that e-scooties or, the electric vehicles, they are costlier than a petrol or a diesel vehicle, correct? So there is a trade-off. You're trading off the financial and the environmental aspect. That is what a trade-off is. So now you read the statement again. It enables decision makers to quantify that what is that impact, to quantify trade-off between various sustainability aspects. So it could be your environment, social. So if you're doing some good for the environment, it is possible that could cause some harm to the society. So these trade-offs keep happening. Like when you're going for an e-vehicle, you are doing positive for the society, but negative for the economic aspect. So this constantly you have to evaluate what is the quantity or what is the quantitative impact of this type of a decision. So it helps to make informed choices. Third advantage is enhanced stakeholder relationships. It improves relationship with key stakeholders and bolsters risk management through consultation. Commercial benefits provides specific advantage in the commercial arena, such as a competitive edge with customers, suppliers, and financiers. A lot of companies, they actively promote that they are using this much percentage of recycled waste in their products. And, the recycling is done in some in good ways, such that it doesn't harm the environment. So whenever customers are aware about these things, now they actively choose such brands because they know that ultimately it's about the long-term sustainability. So when they have the means to do it, they prefer doing some, good for the environment or the society. I'm just remembering that I'm not sure if ITC still does it. There was a time, since now I've stopped using physical notebooks, so I'm not very sure if ITC still does it. When we used to buy the ITC notebooks, it was, it used to be written at the back that ₹1 is donated. For every one ITC notebook that you buy, ₹1 is donated for this and this cause. So what is it doing? Ultimately, are you all able to recall that, this statement which used to be given at the end of, the cover page, the last page of the book of ITC notebooks, that for every one or for every 2 notebooks, ITC notebooks that you buy, the company donates this much for welfare. Okay. So this is what? This is ensuring that the company is doing good for everyone. It's not just economic benefits it is seeking, but it is contributing towards, the society as a whole, the environment as a whole. They also used to plant trees. PNG does that. BMS is which company? Oh, Book My Show. I just Googled it. Yeah. Yeah, Book My Show also does it. Na? They ask you to contribute some 2 rupees and all. So yes, so companies have been actively doing it, that for this thing you do with us as a customer, you transact with us, we also contribute to the society. Okay. Some of this point got repeated, ignore it. Next is reputation and brand enhancement. It enhances reputation and brand, potentially attracting and retaining employees with sustainable values. Okay. In fact, you would have seen that, these e-com companies also recently have made such a shift in the way they are packaging their goods. Uh, they're reducing the use of plastic. So if you have been shopping on Myntra, you will see all of these are paper packaging that you get. The outer packaging is all paper. So it saves on, it reduces the harm which plastic does to the environment. In fact, wherever possible, they use the primary packaging itself. Where the primary packaging of the product is good, they just ship the product like that only. They do not provide any outer packaging to it, wherever it is possible. So this enhances the reputation and brand, and it also makes the employees who are, who have sustainable values to stick with them. Okay. So these are the advantages. Let me know if it is clear. We'll go through the disadvantages next. Okay. So the disadvantages are lack of standards. See, there is, like you have accounting standards. Do you have these standards that every company has to follow these particular ways of reporting? There is no such thing. So even if you are following 3BL or TBL, it is at your own discretion. You do not have to follow rules that the reporting has to be done in this particular format, and which makes it, non-consistent across different companies, and therefore the usability comes down. And the readers of the financial statements, they're not able to relate much and compare much between companies who are following it. So there is very few standards which exist for measuring these effects. Usefulness and comparability, varied disclosure practices, just what I was telling you right now. The usefulness, it comes down because there is no standard reporting mechanism. So varied disclosure practices result in significant variability in content and quality, affecting usefulness and comparability. So you will not be able to compare the ESG performance of, not just the ESG performance, sorry, the economic, social, and environmental benchmarks of companies, because there is no possibility of comparing the data. Blurred lines, the distinction between the economic and financial bottom line is often unclear. Okay, so financial is from the point of view of the accounting, finance evaluation overall. Economic is, it is inclusive of finance. Okay, it is the overall long-term view. So whereas finance, it could be from the point of view of a particular frame of months or years. Economic is the overall, point of view of the organization. So there are sometimes blurred lines which are not observed while you are reporting under the economic and financial bottom line. Then increased reporting costs. Adoption increases annual reporting costs, disproportionately affecting smaller entities. Okay. So when you are taking up, one second. Yeah. So whenever you are taking up this type of a reporting mechanism, the reporting costs, of course, will go up. You'll have to hire professionals, and you'll also have to have an MIS which supports you with the necessary data. Risk and liability, potential exposure to risk and liability concerning the reliability of the report's content unless audit is mandatory. So unless there is proper audit, then it is possible that the, reporting, it may not be true and fair, correct, absolutely correct. And potential bias, voluntary presentation. So it's not like mandatory that you have to go for a 3BL approach of reporting. It is voluntary. So it is voluntary presentation may introduce bias as only favorable information may be included. So because there is no standard that this all set of things need to be reported, so there is no standard, then you'll have to exercise judgment. And whenever you have to exercise human judgment, personal biases tend to kick in. So that can lead to bias in reporting and therefore a disadvantage of 3BL. Please tell me, is it clear? Did you understand the advantages, disadvantages? And what is 3BL? 3BL is reporting from the point of view of environment, social, and economic performance of the company. All right, perfect. So moving on, let's take a question on TBL reporting now. The board of directors of Plum Company are discussing whether to adopt a TBL reporting system increasingly used by the company's competitors. The board would like to demonstrate the company's commitment to sustainable development, but is concerned that the cost of TBL reporting, just what we were discussing, that there would be cost involved with reporting. The cost of TBL reporting would exceed the benefits, particularly as TBL reporting is not mandatory for external reporting purposes. Required, explain what TBL reporting involves and how it would help demonstrate Plum's sustainable development, and include examples of measures that can be used in a TBL report, and discuss how producing a TBL report may help management improve the financial performance of the company, providing examples wherever appropriate. Okay. So I want you to spend some 5 minutes on it. Draft your answer, how you would solve this question. Spend some 5-7 minutes, think about the answer, and share it with me when you're done. I want all of you to participate. Please do practice in the class. See how you'll be able to answer. Now you know the concept. Think of what measures you can give as per the requirement. Okay. So let me know whenever you're done. Anyone who has completed, want to share your answer? Time is up. Okay. Everyone, please pay attention over here. What was the first requirement? Explain what TBL reporting involves and how it would help Plum's sustainable development. Include examples of measures where that can be used in the TBL report. If you have written your answer, please share it with me. I'll review it. Have a look. So first of all, sustainable development. The principle of TBL reporting is that a corporation's true performance must be measured in terms of economic, environmental, and social factors. Okay, with no one factor growing at the expense of others. Okay, Vinod, share your answer, whatever you have done. I'll review it. Okay, I'll just read aloud Vinod's answer. Triple bottom bottom reporting is an approach which concentrates on the corporate performance of the company, not just from the book point of view, but also from the soul. It includes 3 layers of reporting. Economic, it represents the profitability of the organization, modes of procuring the goods, and how well the supply chain management is imparted in the organization. It also includes helps in identifying how the company is growing, keeping in mind growth of their armed supports. Social, its impact is measured how much the organization is to keep a good social responsibility, not just from the stakeholder point of view, but also from a larger horizon. They're using fair practices for the businesses. Are they complying not just the legal formalities, but the moral compass is also used for while fulfilling the duty? Okay. Environmentalist, the impact, how the organization is claiming their profit by not degrading the natural resources, and if doing so, how well they are replenishing them. Good answer, Vinod. The way you have drafted it. Any particular point? It's fine. See, The question was explain what TBL reporting involves and how it would help demonstrate Plum's sustainable development. So I appreciate how you have first explained what all each elements are, and then you have correlated to Plum's sustainable development. There could be more correlation which could be done in the answer, number one. And examples of measures you have not covered. I think that could not be done because of time, but it's okay. But the answer was good. All right. So the principle of TBL reporting is that a corporation's true performance, it can be measured in terms of a balance between economic, environmental, and social factors with no one factor growing at the expense of others. So all the factors are looked from a balanced approach. No one factor is prioritized over the other. A corporation's sustainable development is about how these three factors can be combined so that the company builds a reputation as being a good corporate citizen, a corporation that balances the pressures of all the three factors. So that's what I said, having a balanced view. You can use these terms. Balance is, so it is balancing all the three factors. And it should enhance shareholder value by addressing the needs of its stakeholders. However, whereas TBL reporting is a quantitative summary of the corporation's historical performance, okay, sustainable development tends to be forward-looking and qualitative, okay. So what it is saying is that it is TBL reporting is historical. It is about a company's historical performance. And sustainable development, on the other hand, tends to be forward-looking and qualitative. So forward-looking and qualitative, whereas this is a quantitative summary. You're trying to quantify the impact under each of the three criteria. Because sustainable development is what you are doing for the future, right? So economic impact can be measured by considering operating profits, dependence on imports, and the extent to which the local economy is supported by purchasing locally produced goods and services. So you have to give measures now. So these are the measures. Economic impact, how can it be measured? It can be measured by considering the operating profits, how much you are importing, and the extent to which the local economy is supported by purchasing locally produced goods and services. Some social impact. So the social impact, how can you measure that? And economic impact can be measured by operating profit. Social impact can be measured by considering working conditions, fair pay, using an appropriate labor force, not child labor, and the level of ethical investments. Okay. Environmental impact can be measured by considering the company's ecological footprint or the carbon footprint of the company, emissions to air, water, and soil, use of energy and water, and investments in renewable resources. So this is how you can measure the impact. This is very crucial. Always address the entire requirement. Okay. Ideally, the company's economic, social, and environmental performance should be benchmarked against that of its competitors or against the industry, national, or global leader in sustainable development. So you can benchmark against competitors or you can benchmark against industry also. Okay. So that was the answer to the first question for both the aspects. How TBL reporting involves and demonstrate, what it involves. It involves economic, environmental, and social factors. You can give a brief intro about each one of them. How it is related to Plum's sustainable development, because sustainable development is forward-looking, future orientation. So that is what you can relate to, and then the measures for each of these aspects covered in the TBL report. Now, the next question is always keep rereading the requirements when you're answering the question so that your answer is, in the right direction. As I keep telling, you don't have to write whatever you know. You have to write what is asked. So second one is discuss how producing a TBL report may help management to improve the financial performance of the company, providing examples where appropriate. So let's see what the answer is. So for TBL reporting to improve the company's financial performance, the benefits that accrue from the assessment and production of a TBL report must exceed the cost of undertaking the report. So ultimately, it was given in the question that they are concerned that the cost of TBL reporting would exceed the benefits. So that is what they're asking. Explain or discuss how producing a TBL report may help management improve the financial performance. So when you're looking at improvement in financial performance, you have to consider the cost of preparing the TBL report also. So for TBL reporting to improve the company's financial performance, the benefits that accrue from the assessment and production of a TBL report must exceed the cost of undertaking the report. The cost of producing the report should be relatively easy to measure, but the financial benefits, it can be difficult to measure. Like what benefit are you accruing out of the use of TBL? That can be difficult to calculate. Okay, because it will happen over a long period of time. And from where the benefit exactly would be coming in, you never know. Because ultimately TBL reporting may be getting used by investors, by customers. So you don't know which customer is coming in from the reading of the TBL report that the company has been doing so and so much for the different aspects. So you never get to really quantify the impact accurately. So examples of the ways in which the company may benefit is focusing on and reporting the company's environmental and social impact may build an enhanced reputation of the company and long-term revenues. So as I said, the customers who will be reading these reports, they will find that the company is having a good reputation with respect to environment and society. So they will want to buy from such a brand. Second is reducing the company's environmental impact may reduce the risk of paying fines for environmental damage. So this one is about risk of paying fines that can come down. Consideration and improvement of working standards and consulting employees as part of this process may help in retaining and attracting high caliber employees. See, when you involve the employees more in the discussion, now they feel included, inclusion feeling comes in, and they stick with the company for longer time. And this is actually good. This is the benefit of TBL reporting. Then better communication with stakeholders may result in improvements in governance procedures. This in turn should lead to a reduction in agency costs. Reducing the carbon footprint. I want you to watch a video on this. Let me show you. I have a good video on carbon footprint. An important topic. Quick 2-minute video. Have a look at it. It's a video on carbon footprint. Oh, did I miss it? Oh, sure. I'll review it. 1 second. So I'll finish up the answer and then I'll come back to you. I didn't see that you have messaged also. Sorry. So let's have a look at the video and then we'll come back to the answer.
The Simple Show explains the carbon footprint. This is you. You've probably been hearing a lot about climate change and how you should reduce your carbon footprint. But what is that exactly? Just like an actual footprint, it's a mark you leave upon the environment. No, not with your shoes, but with every action that releases carbons. Those are the harmful gases, such as CO2, which are pumped out by burning fossil fuels like oil or gas. The more fuel you use, the bigger your footprint will be. You may think that by driving your car, the only carbons you release come from the engine, but no. Consider the carbons that are emitted just to get fuel into the tank. From the energy needed to extract the oil from underground, the pollution caused by transportation and refinement, to the final delivery to your local petrol station. Not to mention the CO2 released by manufacturing your car in the first place. More than you thought, huh? So unless you live in a cave, you and everything you own has its own carbon footprint. Read a book? Printing and distributing. It uses energy. Brush your teeth, and your utensils will have a history in a factory. Even something as basic as an apple could have traveled hundreds or even thousands of polluting miles to end up in your local supermarket. You see, it's pretty much impossible to leave no carbon footprint behind, but that's no reason to stop trying. Think about your actions and choices, and you'll be able to reduce your personal mark after all. That's how you really put the boot into climate change.
So I hope you understood that everything, practically everything that we do, it has its own carbon footprint. So we may not be able to, avoid it completely, but we can definitely look at reducing the carbon footprint by adopting sustainable ways of working. Correct? So I just put the link of the video in the Excel if you want to watch it later again. Just 1 second. Activity 3. All right. So where were we coming back? So now that you know what carbon footprint is, yeah, reducing the carbon footprint may be achieved by switching from importing materials. See, if you observed over here, when we were assessing or when we were trying to put on the measures for economic impact, we considered dependence on imports also. So please understand, import means the product travels so much, and in that travel, a lot of fuel is consumed and everything. So it leaves a bigger footprint, a bigger carbon footprint. So reducing the carbon footprint may be achieved by switching from importing materials to using local suppliers. This may reduce the risk of stockouts and also boost the company's reputation through supporting the local economy. So you're supporting the local economy, you're reducing the environmental carbon footprint. So it's like a win-win. Monitoring and reporting on the performance of employees and managers as part of assessment of economic and social factors may help identify areas where work can be done more effectively and efficiently. So when you are working towards enhancing your financial performance through environmental, economic, and social reporting, then there can be proper ways to assess the performance of the employees also on these grounds, so that they also come up with new and effective ideas to improve the performance. Okay, so only when you make it a part of their evaluation, employee evaluation, then only you will get to see good results out of the activity. Okay, so this was the answer. Now see how we are writing in small paragraphs. See, in fact, any paragraph that you're saying is just 2 to 3 sentences maximum, I'm saying. Okay, and then wherever they're seeking some examples or anything, you can just write it down in small bulleted points. Do not write long commentary, and everyone, avoid long sentences. Nowhere you will see extremely long sentences. Maximum length of a sentence should be about 20 words. Okay, do not make long sentences using commas, semicolon, everything. It becomes difficult to follow. I'm seeing that in a lot of answers. So a general suggestion to you all, avoid it. Now I'll go through Jay's answer. TBL refers to triple bottom line reporting, which includes the reporting over economic, not economy, okay? Economic and economy are different. Economic, social, and environment aspects complete the statement. TBL would help Plum Company to identify their areas of improvement, greater transparency and accountability. Now, a feedback to you, Jay. Do not write bullets for every paragraph. Like you have done the numbering 1, 2, 3. Do not do that. You can write in paragraphs, that's fine. But don't number those paragraphs. Unless you're listing down something now, don't use bullets or numbering. Here, you're not listing out anything. See, only when the list came out over here, you used bullets. So, recommendation to you, do not number paragraphs. Like this is not getting numbered. This is not getting numbered. So that's a good approach. You write in small paragraphs as if you are writing a good commentary on something which is asked. Then TBL would help Plum Company to identify areas of improvement. That's correct. Whatever you're writing is right. Sustainable development would lead to improved brand reputation. Also, differentiation could lead to increase their market share, outweighing the costs. Economic impact again. So what you have done now, while you are writing in small numbered list, you are not able to link the points with each other. So it's like every point is speaking about something. Try to correlate the points and build it. That will be better unless you're asked to list down something. Try to build an answer in such a way that the points go in a regular, in a seamless flow, something that you can incorporate in your answers. So sustainable development would lead to improved brand reputation. Also, differentiation could lead to increase the market share, outpaying the cost. Okay, economic impact. Let's summarize the financial performance of Plum Company and economic value created. Social impact will lead to community engagement in Plum Company. Environmental impact, resource utilization of scarce resource, reduction in the emission of carbon pollution, and will lead to improved image of Plum Company in the wider society. So points are fine. What you're writing, just improve this few aspects which I have put. Otherwise, good answer. I think you just shared for the first part. No? Second part is not done. But good answer that you have written. Good one. But also, I think you also did not cover this. The way in which you can calculate the impact. I'm just saying social impact will lead to a community engagement. How do you measure the social impact? That's missing, let's say. Okay. Then environmental impact, you have written that resource utilization of scarce resource, reduction in the emission of carbon pollution. Still, that's fine. Environmental impact is fine. Economic is also fine. Social impact, I think it's getting a little fizzled out. I'm not able to make out what is the measure that you're trying to suggest. So, that's a part of learning process. Once you see such answers, which we are discussing in the class, you will gradually learn these things and you will grow. So it's okay. Like currently now, whenever you all are sending answers, do not think whether it is right or wrong. It's just that I want you to stimulate your brain cells to think, that you are able to think, you're able to write. And then when you see the model answer now, you will understand, okay, I didn't think of this point. I'll keep this in mind going forward. So this is what should be the process. Okay, don't get demotivated that I did not get the answer right. Even when I am, like, anyone who is studying for the first time will not get the answer right in the first go, because now you're learning things. So when you are learning it, practice in this way, that you write your own answer and you see it alongside the model answer and what are the ways in which you can improve. Okay, so it's a request to everyone. Whenever I'm asking you to solve, please solve, share your answer so that you can get a feedback. Okay. All right. Coming ahead. Sure, let's do that. Okay, I was just thinking only, I was just reviewing how much of this chapter is left. I think we have a good chunk of it left. So let's take a break. Anyways, Jay, I think you're joining in for the first day today. Yesterday also we took a break. We'll take a break of 20 minutes. Everyone, please refresh yourself, eat something, and then be back. We'll continue our discussion. Okay. So it's 9:20 right now. We'll catch up at about 9:40. Okay. No 30-minute break. Please catch up in 20 minutes. All right. Please be back by 9:42. All right. You start negotiating on the breaks. Okay, come back soon. Hello everyone, welcome back from the break. Let's continue our discussion. Jay, you can tell me. I can address it now. Or if you want to connect, there's any personal issue, then you can connect with me on WhatsApp. I'm already a part of the group, the AFM group. You can contact me there. Okay. All right. Now comes need for risk management. So risk is the variability of return. See, you have a certain expectation that you're going to make, let's say, $10,000 of profit. But that's an estimation. Is it correct to assume that the actual profits would also be $10,000? It may not be so. That is what risk is. That due to some factors, you are not able to achieve exactly what you think you would. So risk is the variability of returns. It could be positive also, negative also. It's not necessarily risk as the term has to be associated with negative connotation. It may be positive also, that you expected that you're going to make $10,000, but you made, let's say, $12,000. So risk is the variability of returns, both positive and negative. It can be quantified using statistical measures such as probabilities. That there's a 10% chance that the profit would be 12,000, 80% chance that the profit would be 10,000, and let's say $8,000 probability is balanced 10%. So it can be quantified using statistical measures such as probabilities, standard deviation, and correlations between different returns. So always remember this. See, normally now the terms risk and uncertainty, like they are used interchangeably. But from the ACCA point of view, always remember that risk is something which can be quantified, and uncertainty, it also denotes the same thing, variability of returns, but something which cannot be quantified. So risk is something which you can quantify. Uncertainty is something which you cannot quantify. So risk management involves decisions to alter return volatility, such as swapping. So we'll come to that. Now understand what is risk management. Risk is what? That your actual result, it is not the same as the expected result. So I'll tell you an example. Let's come to the notes. You're not added to the group. Have you enrolled with VGLD? Do you have Sandeep's contact number, Jain? Do you have Sandeep's contact number? With whom did you enroll? Okay. All right. So just message me on this number. All right. And I'll ask the team to add you also, and then you can connect with me. Okay, coming back. So what is risk? And risk is what? Your expectation and your actuals are not the same. And I was telling you the number for it, the example for it. So, for example, let's understand you are an Indian importer, an Indian importer has $10,000 payable 3 months from now. Okay, understand that an Indian importer has $10,000 payable 3 months from now. So today, rupee to the dollar is, let us say, 80. I'm taking easy numbers for reference. So the expectation of the Indian importer was an outflow of how much in Indian rupee terms? 10,000. Can I say 10,000 multiplied with 80? His expectation was an outflow of rupees 8 right? The expectation of the Indian importer was an outflow of 8 lakh rupees after 3 months. After 3 months, rupee to the dollar turns out as 85. Okay. So the actual outflow would be how much? 10,000. Eight lakh 50,000. This would be the actual outflow. Now, please understand the expectation and the reality, they turned out to be different. Don't you think the importer was aware about this risk from day one, that he has a payable 3 months from now? He was aware of this, risk. So the variability of actual results against the expectations is known as risk. Okay, it is known as risk. Risk can be managed through multiple means like hedging. And this, my friends, is going to be one of the most important topics of your syllabus covered in the later chapters. Okay, you're going to learn about currency risk hedging. Okay, so you can manage the risk using hedging. And there are different techniques of hedging. Now, using this and keeping this example in mind, now you come back and read this part again. So risk management involves decisions to alter return volatility. And what would that mean? It would mean the volatility which is coming now, that instead of 8 lakhs, he will receive 8 lakh 50, or he may receive, he'll have to pay 8 lakh 50. It can be, fixed, that this would be the outflow using hedging techniques. So you are killing uncertainty in a way. You're killing the unexpected movements. So risk management involves decisions to alter return volatility, such as swapping. All of this you will learn. I'll not get into the details of it now. We're going to learn it in a lot of details, such as swapping variable interest rates for fixed rates. It's justified if it enhances the company's value by either increasing future cash flows or reducing the required rate of return, ultimately boosting NPV at a lower cost. In simple words, what you need to know is risk management ensures that there is no unexpected movement in your cash flows. You have tried to hedge them, secure them. Okay, so that is what risk management is. While reducing an organization's risk exposure is logical, a blanket approach of hedging all risks may not be effective for several reasons. So it's true that you have to manage risk, but that doesn't mean you will curtail every damn risk of the company. That's not possible. So hedging all risks cannot be effective. Okay. So hedging provides short-term but not necessarily long-term protection. Derivative contracts like forwards, futures, and swaps. Those of you who are coming from the FM route, you would already be knowing about these. You would have solved questions. Forward contracts, money market contracts, right? So like forwards, futures, and swaps align with long-term trends in the spot market. For instance, an appreciating domestic currency can impact margins whether or not exchange rate hedging is in place. Okay, so hedging involves expenses encompassing transaction costs of using derivatives. Okay, so what you need to know is that, first of all, hedging is a short-term means of safeguarding your cash flows. You cannot safeguard your cash flows in the long run. The maximum tenure which you're going to learn is going to be maximum 1 month, 1 year, 3 months, 1 year, but not beyond that. So it's there is very limited option available for long-term protection. And even if it is available, it would be very expensive. So the benefits that you're going to get is going to be less than the cost you're going to incur for hedging the cash flows. Okay. Cost implications. Hedging involves expenses encompassing transaction cost of using derivatives and higher salary cost. And it's a specialized field. Hedging requires the skills of professionals. So you'll have to hire professionals in the company. That also involves costs. Then existing shareholder hedging. Shareholders, particularly listed companies, often hold diversified equity portfolios that inherently mitigate various risks. So understand, from the shareholders' perspective, they remain invested in so many companies, correct? So anyways, their risk gets diversified through investment in different sectors. So they don't really need hedging, and therefore they would not want a particular company to spend a lot on hedging because ultimately it affects their profitability from that company. So shareholders, particularly in listed companies, often hold diversified equity portfolios that inherently mitigate various risks. Inherently, just for the sake of holding a diversified portfolio, you hedge a lot of risks. Corporate risk management may then add costs. That is not what they would want. Because something which is already getting mitigated, why would they want to spend money on it? So corporate risk management may then add costs without substantial benefits if shareholders already have natural protection against certain risks. So if they are getting protected naturally, then why would they want something additional to be incurred, right? So organizations often engage in certain significant risk management for various reasons. So why do the companies then need risk management? Number one, private companies. Shareholders in privately held firms may have a substantial portion of their personal wealth invested in one company. Now think about closely held companies. You might be having, your family members, someone might be having private companies, that's which are closely held by the family members only. So their substantial portion of wealth is invested in just one company, exposing them to total risk. So corporate risk management can effectively reduce this risk. Okay, so for the private companies, the risk can be managed because this needs to be managed because their majority wealth is invested in one company. Then listed companies, even with diversified shareholders, the point which we were observing above, even with diversified shareholders, company management is focused on a single entity. Management now. Think from the point of view of the management, not from the point of view of shareholders. Company management is focused on a single entity. To hedge personal risk, management may become risk averse, incurring agency cost for shareholder. Now, please someone help me interpret this particular line. You tell me what do you understand by this line. You know all the terms. You know agency costs. Think and tell me what do you interpret from this statement? To hedge personal risk, management may become risk averse, incurring agency cost for shareholders. Very clear statement. Tell me, what do you understand from it? Management may charge on profits for hedging the risk. No, no one has got it right so far. Let me interpret it for you. What are agency costs? Agency cost is when the directors, they are not acting in the best interest of the shareholders. Correct? No. Hold on. Everyone listen to me carefully. So agency cost is when the directors are not. So the negative impact on the shareholders' wealth, please listen to me. What is agency cost? The negative impact on the shareholders' wealth because the directors are not acting in the best interest of the shareholders. That is agency cost. Now, keeping this in mind, you read it. What do we know? That shareholders, they do not need any risk management because they have a diversified portfolio. That is a rational assumption because if you are the shareholders of a listed company, normally your shareholdings would be diversified across multiple stocks. So they do not per se need risk management. But still, the management needs to do risk management. Management meaning the directors, okay? The directors need to do risk management. Why? Because please understand, directors are employed in just one company. Their entire source of livelihood is coming from one company. So, to hedge personal risk, now you read the statement. To hedge personal risk, management may become risk averse. Directors may become risk averse. They would not want to take risk, so they will want to manage risk. Although it is not the requirement of the shareholders, directors will want to manage or they will want to manage risk. This incurs agency cost for shareholders. Now, are you able to bridge the gap? That means what is the agency cost? Something the directors are doing irrespective of whether the shareholders are wanting them to do it or not. Got it? So agency cost is the directors are not acting, as per the expectations of the shareholders. And why is it so? Because shareholders, they have a diversified portfolio, but for directors, they have their just one employment in one company. So that is why, to hedge personal risk management may become risk averse, okay? Incurring agency costs for the shareholders. Is it clear, everyone? Please confirm. Did you understand now? Please confirm. So agency cost gets incurred because directors are hedging and it is not expected by the shareholder. So understand, even in listed companies, risk management happens because the directors, they want to safeguard their own personal, and therefore the companies, just as a single entity, companies portfolio. Okay. Tax considerations. Progressive corporate tax systems where higher profits face higher tax rates create an argument for risk management to smooth reporting profits. See, I'll tell you what, the expectations is that the profits should be stable over time. They should not be fluctuating a lot. So progressive corporate tax systems where higher profits face higher tax rates create an argument for risk management to smooth the reported profits, reducing long-term tax burdens. Caution is needed to prevent accounting manipulation. So what it is saying is that due to progressive corporate tax, that means as the more and more taxes are there for the corporates, there is a need to smoothen the profits over years so that the tax implications is also that's also smoothened. Next is cost of capital reduction. Corporate diversification can lead to financial synergy, resulting in smoother cash flows and improved credit rating and lower debt costs. I'll come back to this. Acquisitions must be carefully evaluated to ensure that the control premium paid doesn't exceed the synergy value. Now let's understand the statement. What it is saying is that when you diversify, you're doing an acquisition, and corporate diversification can lead to financial synergy. Meaning what? That when you are of a larger scale, okay, so you can save on the cost of finance. When you have a larger scale, you will be able to negotiate better rates with the lenders now. So corporate diversification can lead to financial synergy, resulting in smoother cash flows and improved credit rating. So you'll be able to honor your interest and principal obligations better. Your credit rating will improve and reduce the debt costs. Okay. Now I hope it is clear. Acquisitions must be carefully evaluated. So when you are actually going ahead and doing this acquisition, you should evaluate the excess that you are paying for that company and see and compare it with the benefit which is coming out of it. So whenever an acquisition happens now, you will be learning about it later. A lot of synergies come in. So you have to see that the extra amount that you are paying to the company, does it, is it less than the synergy benefit or is it more than the synergy benefit? If the extra that you are paying to acquire a company, if it is more than the synergy benefit, then you are making a loss deal for your own shareholders. You're benefiting the recipient company's shareholders, but for your own shareholders, you are making a loss because you are paying more than the benefits that would come out of it. So coming back to why risk management is needed, so that you can ensure that proper and correct acquisitions only happen so that you're not deteriorating the wealth of the shareholders. Then financial distress mitigation. Risk management becomes justified in reducing the risk of financial distress. What is financial distress? Financial distress means that you're not able to honor your obligations of interest and principal on loan. So risk management becomes justified in reducing the risk of financial distress, which can lead to increased business cost during cash flow difficulties. So if you're not able to honor your interest and principal obligations, there can be increased business costs. So you will face litigations and everything. So that can be mitigated by smoothening the profits of a company. Please tell me, is it clear? Yes, increase in gearing ratio actually leads to that, higher financial distress costs. If your gearing is high, gearing meaning that your proportion of debt is getting higher and higher, then it can lead to higher risk of distress costs because the risk of company failing due to non being able to honor the interest in principal obligations is high. Example, Marico. This consumer goods giant focuses on mitigating supply chain risks by building strong relationships with supplier, diversifying sourcing options, and investing in flexible manufacturing processes. This helps them navigate disruptions like rising raw material costs or natural disasters, ensuring uninterrupted supply of essential products to consumers. So, what are they trying to do? They are trying to bring certainty. They have multiple suppliers, okay, and they're not dependent on any one supplier. Okay, so they're not dependent on any one supplier. They have a varied supplier base, so they get a like fixed rate in a way, because if you are dependent on just any one supplier, then they will start negotiating with you. The buying power of the suppliers, it becomes very high. The bargaining power, the bargaining power of the suppliers they become very high. So in those cases, it is always better to have multiple vendors for your raw materials, and that gives you certainty in your business. All right. Can you explain listed again? So listed is standard. So we were reading, right, that shareholders of listed companies, they do not really need risk management because they hold a diversified portfolio. And when you hold a diversified portfolio, you cut down the setting of risk happens. Some company may be good at something, they may be bad at something, and then it gets netted off between various companies. So shareholders per se of a diversified portfolio, they do not need risk management. But still, it's not like listed companies, they do not manage their risk. They still do. Why so? Because when you look at the company as a single entity, ultimately directors are engaged in the business of just one company only. They are not having a diversified occupation. They are working for just one company. And when they look at it from a single entity, they realize that they have to manage the risks. Okay. So to hedge personal risk, management, that is directors, they may become risk averse. Always remember there are three types or three types of people in general. Number one is risk seeker. Those who like to take risk, and therefore, please understand always risk is correlated with rewards. Higher the risk, higher the rewards. So there are some people, but again, you have a probability to lose as well. So risk seeker, there are some category of people who would fall under risk seekers. Then risk neutral. They look at it from a probability perspective that yes, on an average, I'm fine. I'll look at the laws of probability and I will make my decision. And the third category of people are risk averse. Okay, so they are like, in Hindi, as we call fattu. They do not want to take risks. They are, they want to have a very safe, cash flows, that they do not want to, just expose themselves to any type of uncertainty. So there was a risk averse. Yes, Vinith, we have already studied that in APM, right? So to hedge personal risk, management may become risk averse, incurring agency cost for shareholders. So now that they have become risk averse, although shareholders are risk seekers, directors are acting as risk averse, which incurs agency costs for shareholders. What are agency costs? That the directors are not acting as per the expectations of the shareholders. Understood now? Let me know if it is clear. If not, then also it's fine. I'll explain again. Is it okay, Vinith? All right. Moving on. Conflicts between equity and debt investors. Jay says if dependence increases to material level, operational deception in supplier will affect Marico to greater extent and may concern various issues. Yeah, so are you trying to say that if Marico starts depending on any just one supplier, then any type of disruption will affect? Yes, so you're right in saying that if you are dependent on any one person or any one supplier, then chances of your disruption are higher if that particular vendor is not able to work properly. Okay, so you are correct in what you're saying. All right. So this was about conflicts when we were talking about risk management and the conflicts that can arise in difference of attitude towards risk between directors and shareholders. Now coming to the next topic, which is conflict between equity and debt investors. Equity investors are active participants whose returns correlate with the underlying volatility of returns. So, meaning to say, higher the risk, higher the reward. So, equity investors are active participants whose returns correlate with the underlying volatility of profits, exposing them to the company's business risk. Do equity shareholders get an assured return? As an investor in Reliance's share, are you assured of a return that you're going to get 10% return? Is there any sort of assurance? There is not, right? So, equity shareholders are exposed to business risk. Now, read the statement again. Equity investors are active participants whose returns correlate with the underlying volatility of profits, exposing them to the company's business risk. So, they are exposed to the volatility of profits. However, their downside risk is constrained by limited liability, meaning shareholders are not compelled to inject additional capital if the company cannot meet its debt. Now, please understand, your liability as a shareholder is limited to the amount that you have invested in the company, nothing beyond that. So it's not like if the company is not able to meet its obligations, shareholders will be asked to bring money from their own homes. No, their liability is restricted, but yes, that whatever amount they have invested, that can become zero also. That's what happens now when you invest in a company and the company goes bust. You don't get any money from the equity investment. So unlike equity investors, debt investors receive a fixed contractual interest and principal payments, making them immune to business risk. So no matter what, how the business is performing, debt investors will get interest and principal on their investment. The primary risk for debt investors is the company's inability to service the debt, known as default risk or credit risk. So what may happen is that they are not able to get any money in the event that the company is not earning anything. So if the company is not able to, service its debt, then that is known as default or credit risk. Okay. The differing positions of equity and debt investors can result in distinct attitudes towards the company's risk taking, especially when assets closely match liabilities. So I hope now you understand that equity and debt investors are differently placed. Equity investors are exposed to the risk in the business, whereas debt investors, they are having a very safe investment. They are assured of a certain return. Now, equity investors, they develop an appetite for risk, encouraging high risk strategies. So that's what I was telling you earlier. But equity investors, they tend to be risk seekers because they know that their returns are based on the risk-taking capability of the business. If a business takes higher risk, then they will have a probability of receiving higher rewards. Success leads to a spike in asset value, increasing equity. Failure allows shareholders to walk away with limited liability. Meaning what? The maximum they can lose is the amount they have invested, nothing beyond that. So failure allows shareholders to walk away with limited liability, providing high upside potential and limited downside risk. So the upside is unlimited. When you are investing in equity, the upside is unlimited, but the downside is limited. And what is that? The amount that you have invested in the shares. Clear? So this is the difference in attitude. This was about equity. Now coming to debt. They exhibit risk aversion. Okay. Shareholders are risk seekers Debt investors are risk averse. Any fall in asset value reduces debt recoverability. If the value of the assets decrease, it is possible that the company will not be able to service its debt. Rise in assets. So why would it so? Please think about it. Why are the risk averse? They will be like whatever value the company currently has, and if it is able to service its debt on the basis of its current profitability, they will not want any change in it. They'll be like, if the company takes risk and it turns out to be a failure, they will not get returns on their debt investment. Because for them, there is no such unlimited upside. They have a same expectation. So any fall in asset value reduces debt recoverability. Rise in asset value does not yield extra return on debt, resulting in high downside risk. So if they're taking risk, there will be high downside and no upside. Because whatever they're getting, only that much they'll get, even if the company is performing 10x, 100x, 1000x. Debt providers, they get the same return. So that is the difference in attitude of equity and debt investors. Equity investors tend to be risk seekers, debt investors tend to be risk averse. Now let's look at an example of Adani Group. The group's rapid expansion through acquisitions and debt-funded projects raised concerns among some equity investors about risk management and potential over-leveraging. Over-leveraging meaning you are using a lot of debt. You might be knowing that Adani has got a lot of debt in its capital structure. So while debt investors may be more focused on timely interest and loan security, that means they want a safe investment. They will get assured returns. That is what the expectation of debt investors. Please tell me, is it clear? Anyone having any doubt, let me know. Clean and clear. All right. So let's move ahead. Types of risk and risk mitigation. So we have been listening about risk mitigation. So now it's about classifying the risks. Again, two of these risks I'm going to keep on using in our subject ahead again. And that is going to be business risk and finance risk. So finance risk is because of having debt in the capital structure, and business risk is when you have an risk because of being in a certain line of business. I'll tell you what. So think about ITC. ITC is in the tobacco industry, cigarettes. So there is a certain risk of being in the cigarette business. You cannot skip that. So business risk is, as the name suggests, the risk which is there because of being in a certain line of business. So like if you're in the tobacco industry, you are exposed to all the risks which are there in the tobacco industry. And finance risk is what? No, irrespective of whatever is your business risk, the proportion of debt and equity, it determines your finance risk. So finance risk is when the proportion of debt keeps on increasing, then it means what the company is becoming highly geared or highly leveraged. One same thing, okay? So there is a higher risk that the company may falter, that the company may not perform, or it is able to service its debt. So that becomes the finance risk. Now let's go into the theory part of it. Let's read it, and then we'll cover the other risks also. But again, these are all needed from the theory perspective only. These two risks, business risk and finance risk, I'm going to pick up again later in the chapters. So business risk is volatility in operating cash flows, influenced by sales volatility and the level of operational gearing, proportion of fixed to variable operating cost. So what it is saying is, what is operational gearing? Operational gearing is the proportion of fixed cost is to variable cost. Now please understand, fixed costs will be incurred whether or not you have sales. Okay, they will have to be paid. Whereas variable cost will be incurred only when you are making certain sales, because it is dependent on the production. It varies with the number of units produced. So volatility in operating cash flows is influenced by sales volatility and the level of operational gearing, proportion of fixed to variable operating costs. So let me show you something in Excel. 6.3. Fixed cost will remain same irrespective of the level of sales. The variable cost changed. It was 40%. So if the sales came down, the variable cost also came down. Fixed cost is going to remain the same. It will not depend on the level of activity. Now, profit is what? 10. Here, there is a loss. There is a loss of 2. So, what I'm trying to teach you over here is if we calculate operating gearing, fixed cost over variable cost. If the proportion of fixed cost over variable cost increases, if the proportion or if the operating gearing is high, it means that if the operating gearing of a company is high, which means that the volatility in business reflected in volatility of sales has a high impact on profit or loss. So just look at this again. Contribution over fixed cost. Contribution over fixed cost is margin. Contribution divided by fixed cost. No. Margin would be calculated as profit by sales. No? Contribution with fixed cost is not margin. Alright. So if the operating gearing of a company is high, it means that the volatility in business, it reflects in volatility of sales. Okay. It has a high impact on profit or loss. So you can see yourself when the gearing is high, a slight change, a 20% change in sales, it resulted in the profits becoming negative, or it means you started incurring losses. Okay. So now with this, you come back and read it again. Volatility in operating cash flows influenced by sales volatility and the level of operational gearing. Operational gearing is what? Proportion of fixed to variable operating cost. This leads to business risk. Please understand, business risk is reflected in it is there due to a company being a certain line of business. Now, how can you mitigate business risk? Repositioning in defensive industries. You're shifting to sectors which are less affected by economic cycles. Example, food, clothing, pharmaceuticals. These are sectors which are not affected by anything. Like whether it was COVID or anything, the requirement or the demand for food, general clothing, pharmaceuticals actually grew. So, these are the general industries which are very safe. Okay. So converting fixed cost to variable. So what did we understand? That the change of profit into loss happened because of high fixed cost. Correct? So what you can do is you can convert these fixed costs into variable. So outsourcing to transform fixed cost into variable cost. That is about business risk, how you can reduce, or you see, you cannot curtail, you cannot completely abolish or avoid business risk. It will be there, but you can manage it better. Second is finance risk, increased equity returns volatility due to interest payments on debt. What did I tell you? Finance risk arises because of higher proportion of debt. And why is that a worry? The worry is that because you have fixed interest payments on debt. Correct? So how can you mitigate? You can lower the financial gearing, reduce the level of debt. Okay, reduce the level of debt as much as possible. That is how you can manage finance risk. I'm going to tell you one statement later. I'll just say it now also. Whenever the business risk of a company is high, it should try to reduce finance risk. Because if already your business is risky, that means what? There is a higher volatility in the sales that is possible. Understand it now. Business risk is reflected in the sales of a company. So already, if your business risk is high, it means what? Your sales can fluctuate. And when that happens, your if you have high debt, it means what? You have high fixed interest payments because interest on debt is fixed. If there is high volatility in sales, and if you have high debt, it means what? There is a higher probability of the business to fail completely because of not being able to pay interest on debt on time. Did you understand? A very simple statement. Statement is, when the business risk of a company is high, it should work on reducing the finance risk. Is it clear, everyone? Please confirm. All right. Now comes credit risk. Sometimes the credit risk and finance risk, they are used interchangeably, but for the purpose of theory, we have a bifurcation. Credit risk is a risk. It is a concern when there's a lot of perceived debt. So that's what you are going to see, that the ways to curb it also are same. Reduce debt, lessen the company's overall debt, diversify operations, mix things up to even out the cash flow so that your cash flows become consistent. And special purpose vehicle, put safe cash into a separate SPV. The SPV issues bonds backed by this cash, getting a good credit rating. So what you are doing is, instead of taking risks on your own, you are putting the cash in an SPV. SPV is a specially instituted company for, like I was explaining yesterday also. So yes. So what you will do is, rather than you increasing your risk exposure, you put the cash into a separate SPV, a separately instituted company. Now this SPV will issue bonds on the basis of this asset. And asset is what? Backed by cash only in this case. So in this way, they are able to generate or refresh the debt. Okay. So if you have higher debt, you can transmit it to the to an SPV. They will raise money backed by this asset, and they will use the proceeds to cut down your debt. So ultimately, it's like transferring of debt from your company to a specially instituted company. So credit risk and finance risk, don't stress much. They're one and the same only. In fact, the terms are used interchangeably. So credit risk is when there is a lot of debt now, there is a higher probability that the company may fail. So that is what it is. Can we say if we are stuck in the business risk, we can be in the finance and credit risk? It is possible that if you are facing business risk, then it is possible that ultimately all the risk somehow it will get attracted. So business risk is in fact, not just business risk, all the risks are interrelated. So one of the risks which you're going to study is reputational risk. Now, if your reputation goes, then ultimately your sales will get affected. That will also affect your finance risk, that the company will not be able to service its debt. So all of these risks they are correlated. They do not function in silos. Going concern issues due to increased finance oblique credit risk. Yes. So if there is higher debt, then there is a concern with respect to the going concern of a company as well. Now coming to this reputational risk, brand value damage from poor corporate behavior, example, environmental harm or child labor. Mitigation strategy, implement CSR and engage a public relation agency, which will be focused on enhancing your public image. Your meaning the corporate's public image. Operational risk, the risk of loss resulting from inadequate or failed internal processes, people and systems, or from external events. Example would be labor going on strike. So you do not have labor working. There is international shortage of the raw material that you use. So again, you'll not be able to work. So the risk of loss resulting from inadequate or failed internal processes, people and systems, or from external events. So external shortage of raw materials that affected your operations, right? So that is operational risk. How can you mitigate that? Implement models to control trading authorizations, timing, and amounts. So you are implementing models such that the business that is, having a smooth flow, you can do some sort of arrangements like contractual purchase of materials. Okay, so you can implement, trading authorizations that you are authorizing your vendor to supply 10,000 kgs of materials every month at a specific rate. So this type of models you can implement. Set and monitor trade limits for regulatory compliance and overall risk protection. So what you can do is you can have proper, limits in place so that you are not in non-compliance. Okay, so you're basically complying with all the relevant regulations. So that also will not lead to operational risk, because operational risk can arise because of non-compliance also. So set and monitor trade limits for regulatory compliance and overall risk protection so that you're never in the bad books of the regulatory authorities. Next is fiscal risk. Concerns unexpected events affecting government fiscal strength, impacting the business climate, especially in commodity exporting nations. So, you're going to have fiscal risk. That means overall how the government's strength is in the world. So you're of course aware that like in the last 10 years, how India's image in the world economy, it has improved substantially. So that gives you a better status as an Indian company also. So that is what fiscal risk is. It concerns unexpected events affecting government fiscal strength, impacting the business climate. So for example, like I'll tell you that the day of the results, the counting when it happened, if you all follow the markets, you would be aware that the market tanked. During the day, the drop was 9% and it closed at a 6% drop because the BJP could not get a majority. Now, what does it show? That the market, it is, perceiving that if there is a change in government, there could be a change in stance of India's status in the World Forum. So concerns unexpected events, because the exit poll predicted something else. Now, unexpected events affecting government fiscal strength, impacting the business climate, especially in commodity exporting nations. Now, government fiscal strength is how well the government is able to manage its imports, exports, all of that overall. So it's not just about the image, it's all about how the company is able to manage its, how a government is able to manage its country. So how can you mitigate that? You can get assessment done. So if you're investing in, let's say, a foreign country, let's say you're investing in a country of South Africa. So what you can do is you can understand about the fiscal strength of that company by reading reports from different institutions like IMF. IMF is the International Monetary Fund. So these organizations, they publish reports on the status of the different countries, and that is something which you can read to avoid or mitigate fiscal risk as much as possible. Next is regulatory risk. It involves adverse effects from government regulations on business. So if the government comes out with very stringent laws, okay, through then it can affect the business. So how can you mitigate it? Through political lobbying to influence or alleviate unfavorable regulations. So you can have a proper representation with the government that how a particular policy is affecting a particular industry. So you can do that. You can consult with the government. So regulatory risk is because of regulations becoming stringent. Then project risk. It involves variance in project cash flows from expectations. That means project meaning a specific project that you have undertaken. It could be from the point of view of setting up, let's say, a plant. So it involves variance in the project cash flows from the expectations. So what you can do is appoint experienced project manager, carefully select the contractors, establish steering committee for monitoring. So the purpose of the steering committee is to keep monitoring whether the project is steering in the right direction or not. And conduct post-completion audit for process improvement. So once you have done and dusted, then you need to check. You can undertake audits to understand whether there is any scope for process improvement. So that is about project risk. Ma'am, do I need to memorize all these different types of risks? The answer is no, you do not need to memorize it. It's just that, again, you should be aware that a business is exposed to lots of risks. In fact, if you think of it logically, it will come to you. A business is exposed to business risk, finance risk, reputation risk, operational risk. So all of these risks, the company is exposed to. Fiscal risk also we studied. Then regulatory risk, project risk. So it's not that you have to memorize and list them down somewhere, but you should know that these are the types of risks which can affect a business and how we can mitigate under each one of them. Please tell me, is this slide clear to you all? Anyone having any query? Anyone having any query, please tell me. I know it's a lot of theory, but as I told you, it's not a completely practical paper. It's a mix of theory and practical, but rest assured, just a few initial chapters only, they have so much theory. Rest, you're fine. Start finding mix. I hope it is clear. Let me know if there is any doubt, okay? All right, moving on. Just a few topics left from this particular chapter. Again, it's a mix to answer your question. It's a mix. So there are inputs which have been factored into the book. All right. Coming to the next part, and that is finance and business. What did I tell you? Two most important risk are what? Business risk and finance risk. And we have an example on that. So explain the relationship between finance risk and business risk. Now we can definitely talk about it. Explain how risk diversification and mitigation may contribute to a risk management strategy. So to generate a return, so we'll cover this along. I mean, we have already covered this topic. Or you want to try it? You tell me. You want to try it? I'll hide the answer, whatever. You want to try it or you want to discuss it right away? Everyone, as you say. Let's give it a try. I'm giving you 5 minutes. No, let's give it a try. You also dropped your answer and then see how your answer is different from the model answer. So now you have an understanding of both finance risk and business risk. Explain how risk diversification may mitigate, explain how risk diversification and mitigation may contribute to a risk management strategy. So you know about each one of these terms. Try to, build it into the form of an answer. Just 5 minutes. You may draft a small answer, but at least put your thoughts into it. Okay? Everyone share your answers when you are done. Anyone wants to share their answer? All right, let's have a look at the answer. Everyone, please stay focused over here. If you have written your answer, you can share it. I'll review. So to generate a return greater than the risk-free rate. Now understand. So you're aware, right? That the government issues debt, right? And you can invest in that debt. Just give me 1 second. Yeah. So you're aware, right, that government issues debt and uh, that's practically risk-free because governments will not default on their debt issues. They will pay you back your interest and principal. So that is a risk-free return. You are not taking any risk by investing in government bond. Okay. Now, if that was the case, everyone should just put their money in government bonds. Okay, there's no risk. You're gonna get assured returns. But the returns are low. Returns from such safe investments, they tend to be low. To generate a return greater than the risk-free rate, stakeholders, including shareholders, must accept risk, usually as a mix of financial risk and business risk. Directors should focus on the business risks that they believe the company has a superior ability to manage. This will drive the area of businesses that the company chooses to operate in. Such business risks, which might be driven by competitor action, demand, suppliers, and the general economic environment, will generate a degree of volatility in profits and cash flows. So understand that you want to earn a return higher than the risk-free rate. So you invest in different types of companies. So they have to accept some risk. Okay. So that is usually a mix of business risk and finance risk. So directors should focus on the business risk that that the particular company will be able to drive well in that particular industry. Okay. So finance risk. So that was about business risk. It was about business risk. Now coming to finance risk or financial risk. It is generated by decisions concerning the choice of finance, including debt to equity ratio, fixed or variable debt, the currency of debt, and or duration of the debt. So fixed or variable debt, I'll tell you what. Fixed debt is when a fixed rate of return of interest is paid on the debt, let's say 5% interest. And the other way would be some variable rate plus certain, let's say 2%. So, like in India, you would have seen if you have worked in the project finance or any company, you might have known that MCLR plus 0.8%, 1%. That is how the banks give loans. So finance risk can also be there because of a choice between fixed rate loan and variable rate loan. This is something which we're going to cover later in the chapters. Okay. So businesses would not usually want to carry both high levels of business and finance risk simultaneously. What did I tell you? If the company is exposed to high business risk, it would want to reduce its financial risk because it doesn't want to increase its overall risk. Risk management commences with the identification, assessment, and measurement of risk. These are the three key steps. These are the three key steps in risk management. Identified risks must be managed, either avoided. If it's possible to avoid the risk altogether, then you can do that. Accepted, you live with the risk. Retained. So you're retaining the risk. Some portion you're retaining in the business, and managed, retained and managed. So you're keeping the business, but you're managing it. So acceptance is what you're not doing anything to do about that risk. Retaining and managing is what you've retained the risk, but you're managing it. You're doing some hedging techniques. or retained and transferred. So let's say, how can you transfer risk? Through insurance. See, when you take a motor insurance, okay, what happens when you take a motor insurance? You take a car, you take motor insurance, you take a car insurance, okay, and somehow there is an accident, okay. Who bears the risk in that case? You or the insurance company? Who bears the risk of the damage? You or the insurance company? You have taken insurance on the car. Of course, the insurance company, right? So, what does it show? That the risk got transferred. Risk got transferred. Okay. So, in this way, the company gets, an insurance claim, and then it is able to honor the claim, right? So, risk, where was I? Sorry, retained and transferred. So, you took insurance, and you can transfer the risk. So, risk mitigation is any process that reduces the risk of a business would otherwise face. So, you are mitigating risk, meaning what? You're trying to reduce the risk which is there in a business. Risk diversification is a type of risk management in which the impact of the risk is reduced by seeking exposures to offsetting risk. That means you take up such activities which offsets risk. I'll tell you an example of this offsetting risk. So let us say you have your income in dollars. Okay, like I was telling you, importer having a $10,000 payable. Similarly, that can be true for revenue also. If you have your income in dollars, what will happen? You will have to convert that currency into rupee if you're an Indian exporter. So what you can do to save yourself from currency risk, right? What you can do is you can also have, yes, coming to that, you can also have payables in dollars. Like you can take a dollar denominated loan so that the interest payouts on that loan happens in dollars. So what has happened? You have matched the inflows with the outflows. So that also reduces risk. Okay. So that is called offsetting. So risk diversification is a type of risk management in which the impact of risk is reduced by seeking exposures to offsetting risks or risk positions subject to different risk drivers. Example, geographical spread, technological spread, product markets, etc. Risks that the directors believe that they have a superior ability to manage will be accepted, although even risks that are accepted are usually managed in some way, if only by monitoring. You're going to manage the risk. You're going to monitor the risk, whatever is the case. Now, let me tell you the answers given here. These are the standard answers. It's not like you have to learn these answers and interpret it. It's good for learning the concepts. Okay. So don't get disheartened if your answer is different, right? Yes, the Tara model. Correct. Transfer, avoid, reduce, or accept. That's the way to deal with risk, the Tara model. So not included as part of AFM syllabus, but then yes, good that you've highlighted, Jain, that there's a model to manage risk, and that is either you transfer the risk, you avoid risk completely, you reduce the risk, or accept the risk. Like, I'm okay to live with this risk. All right, coming to answers that were shared in the chat, let me read it. Vineet had shared it. Business risk and financial risk are correlated to each other. Both have their specific definitions, but one affects the other. Business risk it is the risk related to the operations of the business. For example, how the day-to-day tasks are carried, the major KPIs to the same, the liquidity ratios, asset test ratios, and inventory ratio, the impacts on the said risks when enhances they will reach to the financial risk as well. No, incorrect interpretation of business risk. You have mixed up business risk with operations risk. That's not correct. See, business risk is because you're in a certain line of business, you are affected by the industry factors. So, like I was giving you the example of tobacco. like IDC being in the tobacco industry, so it is exposed to the regulations which come in for the tobacco, the industry concentration, that all happens in the, so let's say the current company where I'm working, it's in the alcohol industry. So the business risk for this company would be the risks which are associated with this industry. Okay. So let's say the government comes down heavily on the alcohol beverage companies, and it increases the duties, the excise duties and taxes, and different types of regulations can come in, and then the industry shrinks, the prices increase, the industry shrinks. Okay. So that is business risk. What you have done is you have related to the operational risk. So that is an incorrect option. Okay. Yeah, but then that is affected due to the industry now. So what I got your point where you're getting confused, but volatility in operating cash flows influenced by sales volatility and the level of operational gearing, proportion of fixed to variable operating costs. So that's like a byproduct. But the reason why the business risk sets in is because of the line of business it is in. And then you now read the operational risk, the risk of loss resulting from inadequate or failed internal processes. So when you read your answer, you'll find it relating more to this aspect. The risk of loss resulting from inadequate or failed internal processes, people and systems, or from external events. Okay. So business risk is like oil companies facing risk due to Tesla. This is a perfect example because Tesla is coming up with automatic cars, then electric vehicles. So that's a risk to the oil and oil companies. That is a fair example, but do not just relate it to operations or internal processes. That's what the suggestion would be with respect to business risk. Next is financial risk. I'll just read out your answer. The risk related to the finances of the business is considered here. For example, the type of debt incurred, the segregation of the equity debt to equity ratio becomes major KPI in this factor. An increase in the set risk will impact the day-to-day working of the organization and the industry with the business. So both the risks are different, but the same are impacted with each other. Okay. So you have mentioned about KPIs. See now, general point again. Explain the relationship between finance and business risk. And then explain how that I'll come to your answer later. But there was no specific ask on the KPIs, but I saw in your answer for both business risk as well as finance risk, you have included KPIs. That was required in one of the previous questions when I was asking about the measures. But in this particular question, there was no such thing. They were just asking you about the relationship between business risk and finance risk. Okay, like one of the statements which I told you when I was explaining the concept, that if a business has a high business, if a company has a high business risk, then it focuses on reducing the finance risk. So that sort of a relation should come out after you have explained both types of risks. Okay. So see now if you read here, so they have first explained about business risk. Okay, they are driven by competitor action, demand, suppliers, and the general economic environment, like I was explaining you, right? So this is what you have to put into words. First, you explain business risk, then you explain business finance risk, and then you correlate both. So businesses would usually not want to carry both high levels of business and financial risk. Okay. So operational risk is appointment of Cyrus Mistry, and then he bringing up mismanagement in data. That's more like a reputational risk, in my view. Because appointment of a director, that's not an internal process. But what he did was he brought up the mismanagement or the corporate governance issues. We discussed this example in the class yesterday, Gagan. And everyone, those of you who have joined us today now, please do watch the recorded lecture. I saw your query in the group also, Gagan. The link, the video will be uploaded on the LMS. And you'll be able to see it by Tuesday. I think they upload Tuesday or Wednesday, you would get the links. So, you'll everyone, those of you who have not attended the previous lecture, please do watch it. We covered a good number of topics yesterday also. So we covered this examples. It's more like a reputational risk which happened. Okay. And when he highlighted the mismanagement, it was because of the corporate governance issues. Okay. Operational risk is how OTT get over the local cables. Again, you're mixing up. That would be business risk now. For the local cable companies, that would be business risk. Their entire business foundation changed because of OTT coming in. Yeah, that would be business risk. Operational risk is how the local companies are managing their business, the local cable companies. Internally, what type of vendors they have, what type of payment terms they have. These are all operational factors. Business is to look at it from the holistic perspective. Okay. Then coming to risk mitigation in your answer, risk mitigation and diversification. Mitigation is the manner how the risk can be reduced or avoided, while the diversification is the method how the risk is distributed so that it impacts the least to the business. Risk mitigation is considered how the above KPIs can be controlled by avoiding the measures which are impacting it, while diversification is more towards how the risk can be bucketed and used in a manner it can be tackled. More of the business risk is the responsibility of the operational segment of the organization is majorly considered very high the companies. This is again because of your wrong interpretation. Your last statement is also incorrect. It is not the responsibility of the operational management. Business risk is also driven by the senior management. Yes, so this is correct. What your example you're giving now, no? How Bescom is not able to collect the cash. Like Bescom is the for everyone those who are not native to Bangalore. So Bescom is the electricity department of Bangalore. So they gave some free units and all. Now they are not able to manage the free units of electricity. So that would be internal process issue, and that is an operational risk. So now you are right. Okay. Coming back now, risk mitigation, hedging, and diversification. Risk mitigation is it aims to reduce the impact or probability of adverse risk. So you're trying to reduce the impact. It involves management controls, hedging or avoiding risk. Example, mitigating political risk before establishing an overseas subsidiary by negotiate agreement with officials. So you have a good terms with the department, with the government. I'm not saying like under the table. I'm not saying under the table association with the government, but being on good terms with the government, so that when you start off a project over there, then you get some sort of like a safety net that the government is also promoting and encouraging your business over there. Risk hedging is what we're going to learn. It intends to diminish a company's risk. It involves financial instruments like derivatives or corporate strategies like sourcing inputs in the same currency as sales. Like the example I was telling you. If you have inflows, the income coming in dollars, you will also try to have outflows, that is expenses coming in or happening in dollars. So that is risk hedging technique. Risk diversification is what? It involves diversification domestically or internationally. Okay, shareholders' portfolio diversification reduces unsystematic risk. Again, this is something which will come in the chapters later on. Unsystematic risk is when the shareholders invest all their wealth in just one stock. That's an unsystematic behavior. That's an irrational behavior. So shareholders' portfolio diversification reduces unsystematic risk. What is unsystematic risk? Investing complete wealth in just one stock. Suggesting that diversified companies may specialize. So they can focus on their areas of business because overall the diversified portfolio will cut down the business risk, finance risk overall. Now, developing a framework for risk management. Various organizations have developed numerous examples of risk management systems and processes. In a sense, a comprehensive risk management process should encompass at a minimum the following elements. Okay. Yes. What is your background, Jay? Like, how do you know about this? So I took a background in introduction of all the students yesterday. You were not there. So you have done any of the papers of ACCA or you have any other qualification? I guess. Oh, you have cleared 11 papers. Oh, nice. So you're going from the knowledge and then skills level. Very nice. Good. And how many papers are left for you, Jay? Okay, just two, including AFM. AFM and what? Then also I would want to hear from you. Like I got introduction from others yesterday. All right. All right. Okay. Good. SBR and AFM in September. Nice. Normally now, SBR people couple it with either audit or SBL. AFM and SB are just thing again. Like if you're just studying, then it is fine. If you're doing both two subjects working full time, then just see if you're able to manage it. But it's a good choice, anyways. But just devote enough time so that you're able to focus on both the papers. Okay, working full time till this week. Now then it's fine. So moving forward, you will be just studying now. Then it's fine. Risk mitigation includes hedging. Risk mitigation includes hedging. We can say that. Yes, yes. These all are terms, interrelated to each other. By hedging, you are trying to reduce the risk in the company. So yes, mitigating is, gets included over there. Okay. All right. So we were studying about the different elements. They have developed numerous examples of risk management systems and processes. Okay. So what are the elements over here? Lectures are from 7 to 12. Okay, Jay? 7 to 12, Saturday, Sunday. No. I think you're not part of the group now. That's why you're struggling because the messaging also. I don't know what type of confusion is happening. Let me check with the team. But at least for this one, what you were saying, Jay, the introduction was sent in the group. I think you're not added. That's why you're having a concern over here. The batch timing was mentioned as 7 a.m. to 12. Okay. So, anyways, it's okay. The classes, I'm confirming that it's from 7 a.m. to 12 p.m. And Gagan, actually, I don't know what confusion has happened. FM classes, not AFM. So AFM I've kept on Saturday, Sunday because most of you are working and everything. So I've kept AFM on Saturday, Sunday, and FM is happening Monday to Friday. So I'm not sure who has communicated that. But rest assured, everyone, the classes are Saturday, Sunday, 7 a.m. to 12 p.m. Okay, one thing which I want to discuss with you now, next Saturday, I have some prior commitment, like something that has come up, and I'll not be able to take the class in the morning. Is it fine if I keep an evening class just for that next Saturday? Otherwise, the timings are fine, only 7 a.m. to 12 p.m. Next Saturday, if it is possible, we can keep the class from, let's say, 4 to 8, 4 p.m. to 8 p.m. or 4 to 9, depending. Then we'll just see because morning time I'm not able to fit in. Okay, so 4 to 8 is also fine. Then that's fine. So we'll take up we'll take up the class. I'll inform the group also, but again, it's not confirmed as of now. If it happens, I'll have to travel somewhere. So if it happens, then we'll keep the class at 4 to 8. Otherwise, I'll keep it at the regular time of 7 a.m. Okay. All right. Coming back. So various organizations have developed numerous examples of risk management systems and processes. In a sense, a comprehensive risk management process should encompass, at a minimum, the following elements. So these are the elements which you need to keep in mind when you are doing a risk management. That is, you identify, you analyze, you plan, approach, and then take action, and you keep monitoring it. So in this way, you ensure that the risk gets monitored, risk gets managed at an overall level. So The thing is now, reason I'm keeping it till 12 now. See, I personally prefer that the sooner the class gets over, the batches get over, it leaves you as students more time to self-study. That's what I prefer. I don't like to stretch classes till the last. So that's why I recommend that, let's keep the class till 12. Uh, let's see. I mean, what I do usually, I tone down towards the end so that I understand what you're talking about. But don't worry, you'll not struggle with that. I try to keep it toned down towards the end. So don't worry about that. Because ultimately, the more the time we give, it leaves you with more time towards the end to do self-study. That would be better for you. I thinking from the long-term point of view. That's why I've kept the schedule from 7 to 12. But if it's still, later on, if I feel that, students are not able to cope up, then again, I can, of course, rethink of it. Not a problem. Okay. So there's no hard and fast. Don't worry about it. We'll just discuss and move on with it. So here we have risk management system. Discuss the possible advantages and disadvantages of setting up a risk management system to identify, classify, and avoid or manage. Okay. All right. So I have a message from Gagan. He's introducing about himself. Okay. So CA Inter passed 2015, left studies for 8 years while working full time, started ACCA as working in a UK company, started with 7 exemptions and completed FR and FM. Now up with PM and SPR and AFM, trying if possible otherwise 2 papers in September 24. Nice, that's good. And it's really good to see you back into studies. I mean, okay, just to share, a lot of students I have mentored, they were the ones who had left studies. Some of them were not able to complete CA or, a lot of those students also. And they have delivered exceptional results. Okay, so keep your hopes high. I'm sure since you have already passed a few papers, I'm sure you're doing well, Gagan. So always there to support each one of you. I'm just referring to Gagan right now, but to each one of you, there to support you in your journey in ACCA, not just restricted to AFM, but overall also wherever you need support, just reach out to me, okay, and then I can help you in whatever way is possible. All right. So coming back, so what we have to do over here is we have to discuss the advantages and disadvantages of setting up a risk management system to identify, classify, avoid, and manage risk. So let's review the answer together. Last question from this chapter. With this, the chapter will also get over. Let's have a look. So risk management is a process which begins with the identification. What did I say? 3-4 steps. Identification, analysis, and quantification of risk before then deciding on which risk management response would be most appropriate. So identification, analysis, and quantification of risk is the core area of risk management. Before then deciding on which risk management response would be most appropriate, such a process will be driven by the risk appetite. What do you understand by risk appetite now? Tell me, what are the 3 attitudes to risk? Risk seeker, risk neutral, risk averse. Okay. So risk averse is when you do not want to take risk. Risk neutral is when you have, you have a probability based approach to risk. And risk seeker is when you take on risks as much as, the appetite permits. So it depends. Such a process will be driven by a risk appetite of the company, the shareholders, and the other stakeholders. So every company has its own risk appetite depending on what type of policy it follows. So the core of this approach begins by identifying the strategic direction of the company. The strategy should emphasize those core areas where the company has a comparative advantage or ability to manage risk. To bring, to keep it in simple words, what it is saying is that risk management, it will be dependent on the risk appetite of the company. Okay. Whether it is risk seeker, risk neutral, risk averse. Okay. And what does risk management involve? Identification, analysis, and quantification of risk. Now, the core of this approach, it begins by identifying which direction the company wants to pursue. It should focus or emphasize those core areas where the company has an advantage. So whenever you are managing the risk, you need to evaluate what is your company good at. Okay. So good way to remember. But don't just use it in exam. Don't write for two. You not get marks. Okay. So it will usually be the case that even where a company has a special ability, there will be risks. So you may be good at something, but again, still there may be risks. There will be risks that it does not wish to retain. These should be transferred by means of insurance, like I was giving you example now. So this can be transferred by means of insurance, derivatives, and subcontracting or the like. Risks such as foreign currency risk or interest rate risk usually fall in this category. These are two different chapters. Okay, these are two different chapters. You're going to learn about them later on. Okay, so I'll just repeat what are we discussing. We're discussing the advantages and disadvantages of setting up a risk management system. Now, understand that how the flow of an answer goes. So first you talked about what risk management is. Okay, and how can you implement it by seeing the strategic direction of the company. Now, how it can be done? It can be done through, the means of insurance, derivatives, and all. Now, other risks may be retained, but will be the subject of careful management, or you'll have to carefully monitor the risks. If you're retaining the risk and you're not doing anything about it, that means you're accepting the risk, then you need to monitor them very closely. Examples might include health and safety risk or public liability risk. So you're living with that risk. So make sure you're monitoring it, you're monitoring the health and safety of your employees. So other risks may be so severe that the company is not prepared to take them at all. So only in this case should the business model be adapted to avoid such risks. Okay. Risk management can add value if the costs are outweighed by benefits. Example, reducing profit variability makes it easier to plan or reduce financial distress costs. What are financial distress costs? The cost of, closing down the business because of not paying or not servicing the debt on time. Risk management should be seen as connected to, but different from the management of business strategy or funding decisions. Okay, so it is different from your regular strategy or funding decision. It is an overall holistic view of the company's risk profile. Okay, so what I'll do now, I'll capture the TARA model, the summary sheet, not a part of the syllabus, but good if you can put the answers in that framework. One second. That is something which you can choose. Let's capture the one. It's point one. TARA model for risk management. First is transfer, then avoid, reduce, and accept. Okay. So definition and examples. Let's cover it in short. So transfer is when you shift the risk to another party. Shifting the risk to another party. So how can you do that? You can do that through, absolutely right, purchasing insurance to cover potential losses. Like we discussed the example of motor insurance. Then next is what? Avoid. Avoid is what? Eliminating the risk by not engaging in the activities which carry the risk. So you're completely like avoiding it. You do not want to associate yourself with that risk. So eliminating the risk by not engaging in activities that carry the risk. So how can you do that? Example would be deciding not to launch a new product in a high risk market. So you're avoiding the possibility of a product failure completely. So you're deciding not to launch. Okay. So that is an example. Now, next is reduce. Reduce is what? Reduces what? Minimizing the impact or likelihood of the risk through various mitigation strategies. Okay. So how can you avoid it? You can take up hedging instruments like derivatives can be used to reduce risk. Okay. And then accept is what? Acknowledging the risk and decide to accept it without taking any special measures to mitigate it. Yes. And examples of it would be accepting minor risks that are part of normal business operations. Absolutely right, Jain. You accept the risk when the impact and the probability of risk is low. Correct? Okay, so just put it here for reference. You can read it and apply it while you are discussing questions on risk management. Transfer, avoid, reduce, and accept. Okay. All right. So with that, the chapter is over. All right. So now what you have to do now, I'll just show you. You're gonna get the books very soon. I think Sandeep messaged in the group. I'll just open that one second. AFM. So you will get the full PDF of the book on your portal by today or by tomorrow. Chapter 1 is complete. So full PDF you're gonna get. So when you get the PDF now, just yeah, it will get loaded. You're not getting the books. It says that the ebook version has been uploaded. Just reach out to Sandeep Vineet. He has messaged that the ebooks have been uploaded. If you're not finding it, then message him. Did you get a response from Sandeep? Not a valid one. All right. Let me check. Let me check. Yeah, I've also messaged that ideally it should be available. You will get it on the portal, okay? Let me know if there is still a problem. So there are questions now of chapter number 1. It's on page number 253. Let's go to page number 253 plus 3 plus 3. So here I have some questions over here, okay? So go through these questions. Meza company, all right. So it's a 25-mark question. Then there is this agency relationship. Explain the term. Now we know about all of these agency relationships. The ethics of Gurukul. Again, 6-mark question. Question 3. So 3 questions are there. Now let me tell you one thing. This Meza company, now this is a past question paper. Past question which has come up in the past papers. There used to be a time when there was 100% theory questions in AFM paper also, but no longer they are asked. You'll not get such a big theory question anymore. But I don't want you to avoid it. It's a good question for learning. So just read through it and see what are the learnings from your question. So, but don't expect completely theoretical questions. And no question will be like of total 25 marks. They will break it down into small parts. They could give you a question, let's say 8-mark, 10-mark question out of the total 25 marks for risk management strategies or whatever we have learned in the chapter. But no complete theory question would be there. So don't see it as like an exam question, but just look at it from the learning perspective. Okay. So just do these 3 questions during this week and read through the answers properly, read through the notes, the class content that we have covered, and let me know wherever you have any struggle. I'll discuss it in class. Okay. Now let us come to chapter number 2. Now take a respite. That theory part mostly is over. Small theory bits will keep coming in, but first chapter was completely theory. And those of you who come and join AFM with the point of view that it's practical, they get a little anxious that we are doing so much theory. So don't worry. Now completely theory part is done. Now we'll keep seeing some theory, some practical, but the theory also now which will come will be mostly like having a practical orientation. Okay. So the chapter is security valuation and the cost of capital. Those of you who are coming from the FM route, they will have some prior knowledge on it already. And those of you who have done CA and all, you will also have prior knowledge. But for me, all of you are completely unaware. I'll be teaching the topic as if no one knows anything. Okay. So keep a clean slate in your mind and approach the topic. Okay. All right. So in examining efficiency, 4 interrelated perspectives are considered. Which efficiency? The capital market efficiency. Okay. So allocative efficiency, it focuses on whether the market directs funds to the best performing companies. Now, please understand. So, Gagan, the book has been drafted from the AFM point of view. Some of the topics are assumed knowledge, but when I am taking up the topic in the class now, I'll explain it to you. So don't worry if you do not have prior knowledge of the FM paper. I'll cover it in complete depth. Okay. Sorry, depth. Okay. So in examining efficiency meaning the capital market efficiency. What is the capital market? What do you understand about capital markets? What do you know about capital markets? The secondary markets, correct. So, there's a theory which is there at the FM level. One second, I'll just put it in the. Yes. There's a concept called efficient market hypothesis, which is there at the FM level. So just taking up the notes from there and putting it here for your reference. Yes, yes, yes. That's no one can outpay the market. So there are different level of efficiencies under that. Um, I'll just one second. I'm looking up that particular table. Am I audible? I saw an error on my screen. Am I audible? Please confirm, everyone. Audible now. Okay, okay. All right. Got it finally. Uh, I'm copying the notes from there. One second. This is assumed knowledge from AFM, sorry, FM level, and we discuss this now. Don't worry, don't worry. I'll not uh, burden you with a lot of new topics. It's just assume knowledge. In fact, you will be having a good time revising it actually. Let's put it over here. You can't see the Excel. Anyone or is no one able to see the Excel screen? I just okay. Now you can see. Now take it. So let's quickly revise this concept of EMH again. Assumed knowledge from FM, but we'll do it. So efficient market hypothesis is according to the EMH, stocks always trade at their fair values on exchanges, making it impossible for investors to purchase undervalued stocks or sell stocks for inflated prices. Okay. Thus, the EMH states that share prices reflect all information. That means they say that it is impossible to outbeat the market. Market knows it all. That's what efficient market hypothesis is. It hypothesizes that stock trade at their fair market value on exchanges. So proponents, those who believe in EMH, proponents meaning those who believe in EMH, believe that an investors benefit from investing in low cost passive portfolio. That means you carry a low cost portfolio. That means having limited transaction cost, and passively you can make returns. Critics of EMH, that means who do not believe in the hypothesis, they say that it is possible to beat the market and that stocks can deviate from their fair market values. You would have heard now, like this particular stock is overvalued, this is undervalued. If you are actively engaged in the stock markets, you would have definitely heard these statements. So it is a hypothesis, it's a theory, okay? Efficient market hypothesis. So it says that stocks, they always trade at their fair value. They are always at their fair market value. And the market has factored in all the information about that stock in its price. Okay. Now, there are forms of EMH. And that is allocative. One second. No, not necessarily through manipulation, but because of market forces only. That the demand for a particular stock goes up, which is not consistent with the type of value it is holding. Okay, so it happens sometimes. So forms of EMH, it is also that is a part of the yes, noise trading. Correct. So the four interrelated perspectives which are covered in the syllabus also. Allocative, efficiency, allocative efficiency. It focuses on whether the market's direct funds. So allocative, as the name suggests, it's about allocation. So ability of financial market to direct funds to companies which use them more profitably. So allocative efficiency says that yes, the stock markets, they allow the funds to get directed to more profitable companies. All right. Next, you have operational efficiency. So it says that it examines the transaction cost and the accessibility of the trading platform. I'm sorry. It examines the transaction cost and the accessibility of the trading platform, promoting a liquid market with a high transaction volume. That means there are minimal transaction costs. Okay. So it examines transaction costs. So operational efficiency is about the transactional costs. Okay. So it examines transaction costs. So it is about transaction costs, and this is about, directing the funds. So it examines transaction costs and the accessibility of the trading platform, promoting a liquid market with high transaction volume. So Indian markets, are they operationally efficient? Tell me. Looking at the definition, can you say that the Indian markets, they have operational efficiency or not? There are high volumes. The markets are liquid. There is a lot of fund flow in the Indian markets, right? So it has operational efficiency. Correct? Next, we have one more, which is informational efficiency. Informational efficiency. And it evaluates whether all pertinent information is readily available to all investors at low cost. So Indian markets, they also have informational efficiency, that the information is available to the investors. Okay, there are a lot of media houses, publications, which give information about the stocks. And the last one is pricing efficiency. Okay. So pricing efficiency is when it assesses whether share prices rapidly and accurately reflect all known information, often referred to as information. I'll write it upwards. So pricing efficiency, it assesses whether share prices rapidly and accurately reflect. So this is whether information is available. Do understand the difference between informational and pricing. Informational is that the information is readily available to the investors who want it, who need it. Pricing efficiency is when it assesses whether share prices rapidly and accurately reflect all known information about a company, often referred to as information processing efficiency. That means the share prices, they are processing the information very quickly into the share prices. The stock markets are efficient in processing the information and reflecting it in the stock prices. Okay. Now, this pricing efficiency. Okay. So forms of pricing efficiency, this is a important topic, and again, a simple one only, but just have a knowledge of it. You're not supposed to know it in depth, but again, it was covered in length at the FM level. So you are assumed to be knowing this. So no one stops ACCA from asking you questions because they assume that you know everything. So types of pricing efficiency. So what is pricing efficiency? Quickly tell me. That the stock market is processing the information, whatever is available, into the stock prices, right? So, yeah. So there are different forms of price efficiency. Number one is zero. This form suggests that the stock prices fail to reflect a wide range of factors that impacts the share price. So it means that it doesn't have any pricing efficiency. It is zero price efficient. The stock prices are not reflecting the information which should ideally affect them. That is zero price efficiency. Weak form efficiency, it is about that all the past trading information, including historical prices and volumes, is fully reflected in stock prices. Therefore, technical analysis, which tries to predict future stock prices based on past price movements and trends, cannot consistently outperform the market. So it says that, in a weak form market, all the past trading information that is factored in the share price. So whatever you're going to anticipate on the basis of what has happened in the past, it is already factored in the share price. People who do technical analysis, what do they see? They see charts and patterns and they say, this has happened in the past in the stock. This is what's going to happen. So weak form of price efficiency says that only past trading information has been factored. Okay. So technical analysis cannot be used. You cannot use charts and patterns to predict what the movement of the price would be because the price has already factored that into it. Okay. Next, we have semi-strong pricing efficiency. What is pricing efficiency? Keep that in mind. Processing of information into the stock price. Remember it in simple. Now, semi-strong is what this form suggests that stock prices include all past information and publicly available information. So this includes news releases, finance statements, economic data. So whatever information is available in the public domain, that is factored in the price of the stock. So according to the semi-strong form, neither technical analysis nor fundamental analysis can produce excess returns. So it means that you cannot beat the market by doing fundamental analysis or by doing technical analysis. Technical analysis is analysis done using charts and patterns. And fundamental analysis is by looking at the balance sheets of the company, because balance sheet or the annual report of the company is a publicly available information about the company. So semi-strong pricing efficiency market, it says that that is already factored. The balance sheet information is already factored in the share price. So you cannot buy and sell securities to make gain out of this information. And the last one is strong form pricing efficiency. So the strong form of EMH states that stock prices completely indicate both public and private information. Past is already obviously factored. Past, public, as well as private information is factored. So a country or a particular stock exchange may be of any form. It could be of zero form, it could be of weak form, any one of them. If it is a strong form efficient stock exchange now, it says that it is factoring the insider information also. So this means that not even insiders with confidential information about their company can consistently achieve higher returns. So it's like a gradual change. Zero is nothing can, nothing affects the price. Weak is when the past trading information, it is reflected in the price. Semi-strong is past plus public is already factored into the price. So if someone has insider information, then they can benefit from it in a semi-strong form of market. So if it is a strong market, efficient market now, so in that case, neither past information, nor public information, nor private information can benefit you. You cannot outbid the market at all. Okay. So that is the types of pricing efficiency which are there at in a stock market. Okay. So these are the forms of EMH which you need to know. Allocative efficiency, operational efficiency. Operational efficiency is about the transaction cost. Allocative efficiency is being directing the funds to the companies who need it. And all information which is readily available. Okay, information is readily available to the investors, and pricing efficiency is when that the information, okay, it gets processed or it gets reflected. Share prices reflect all known information or not. That is something which you should know. Everyone, is it clear? Did you understand what EMH is? Please confirm. I've put it in the notes slide. You can refer to it later on also. It's put in details. I hope it is clear. All known information includes the insider information also, yes. So yeah, if you're talking about strong market form, then yes, even insider information, it says is factored in the stock market. So even if you're having, you're happy that you have some insider information and you're going to trade in the market and make profits out of it, you'll not be able to do so in a strong, firm, efficient market. Okay. Allocative is when, okay, let's have a look over here. Allocative is when, so markets, they have the efficiency that they can direct the funds to the best performing companies. So it's not like the funds are restricted to some limited companies. Every company which is a part of the stock exchange, they have the ability, or they have the proper channels to get the funds. So allocative efficiency is that markets, they have the efficiency to allocate the funds to the companies which are the highest profit generating. Understood? All right. So now in examining efficiency, now you know in detail what efficiency they are talking about. 4 interrelated perspectives are considered. Now we know about all of them. Allocative, operational is about transaction cost. Informational efficiency is that information is available to the investors. And pricing efficiency is what? That whatever information is there, it gets processed into the share price. So the predominant focus of market efficiency research has been on pricing efficiency, which we discussed in length about, the weak, zero, weak, semi-strong, strong. Okay. Now, let's have a recap of this as well over here. The valuation of a share hinges on the anticipated future cash flows derived from owning that share. So we're going to learn this later. Please understand, the market value of a share is nothing but the present value of the cash flows which would happen from the share. Okay, whatever cash inflows that will happen, it's called the dividend valuation model. Some of you might already be knowing. So the valuation of a share hinges on the anticipated future cash flows derived from owning that share, typically manifesting as dividends or share buybacks. The correlation between a company's performance and its share price is influenced by the pricing efficiency of capital markets. Now, we have already learned pricing efficiency categorized into different forms. The EMH categorizes efficiency into 3 levels. Here we have mentioned 3, but then there is a 0th level also, which some theories include, which some theories don't, but it's okay. You can include 0 as well. So 0, we know nothing affects, nothing affects the stock price. It's a 0 price efficient. It means what? It is not able to process the information into the stock price. So in a weak form efficient market, current share prices encompass all information within past price records. So whatever is the past trading information, that is factored in the current share price. If this efficiency is achieved, forecasting price movements based on past trends as attempted by chartists or technical analysts should not lead to outperformance against the market. So you cannot beat the market by doing technical analysis if it is a weak form market. Consistently outperforming a weak form efficient market is attainable through analysis of publicly available information. Why? Because in a weak form market, public information is not factored in the stock price. Only past information is factored. So how do you need to remember it? 0 is nothing. Weak form is past gets factored. Semi-strong is where past plus public information gets factored. Strong is when past, public and private information gets factored in the share price. Absolutely correctly summarized. That is how you need to memorize also. Okay. So semi-strong form efficiency. Oh, sorry, I was reading the statement. Consistently outperforming a weak efficient market is attainable through analysis of publicly available information, emphasizing fundamental analysis such as examining the financial statements. Like I was telling you, the annual report. In a weak form market, you can make returns by analyzing the annual reports of the company. Semi-strong form efficiency. In a semi-strong form efficient market, share prices accurately incorporate all presently available public information. So consequently, price adjustments occur only with the introduction of new information. As new information is inherently unpredictable and can be either positive or negative, share prices follow a random walk with drift. What is it, ma'am? Not understanding. It is saying that, see, the share prices are factoring the public information. Now, public information can be positive also. It can be negative also. So the share prices, they follow a random walk. Okay. So random walk is when a good information comes in. When a good information becomes public, the share prices go up. When a bad information becomes public, the share prices go down. So it walks, it takes a random walk. It keeps going up and down. So now read it again. As new information is inherently unpredictable and can be either positive or negative, share prices follow a random walk with drift, where the upward drift signifies a fair return for the associated share risk. Drift upward is that higher return, and downward would be your lower returns. So beating the market, gaining an unfair return is only feasible through insider trading. So here you can make a gain through insider trading. Here you can make a gain using analysis of publicly available information. Okay. So using significant non-public information, however, again, like in India, insider trading is illegal in most markets and deemed unethical in any market. Illegal in some markets, unethical in all markets. Using insider information to trade is unethical. All right. Next, we have strong form efficiency. In a strong form efficient market, share prices incorporate all relevant information, including unpublished details about the company. This level of efficiency renders share prices unpredictable, and gains through insider dealing become unfeasible since market already possesses that information. Even insider information is factored into the stock price. So stringent regulations, particularly in major markets like London, New York Stock Exchange, prohibit insider dealing. However, in reality, many markets are deemed semi-strong efficient acknowledging the difficulty in achieving a state where all information is factored in the share price. So mostly the markets, they tend to be semi-strong in the way that they can, investors can make gain by using insider trading. Is it clear, everyone? We have covered it in very short in the notes part. I hope it is clear to you all. Everyone, please confirm anything that you're not understanding from here. If info is negative, can short sell to achieve advantage of the weak semi-strong market? Absolutely right. If information is negative, you can short sell. What is short sell? You sell first, and then when the prices go down, you buy. Okay, that is short sell. So normally what happens, we buy something and then we sell. But markets allow us to short sell. What is short sell? You are selling something which you don't own. You're gonna own it, you're gonna own it back later to close the transaction. So that is short selling. All right. So coming to examples now. HDFC Bank, often cited as a success story for efficient markets, HDFC Bank's consistent growth, focus on fundamentals, and strong corporate governance practice align with the EMH view. Its stock prices generally reflects robust financials and long-term growth prospects. Define EMH. So there is a stock within the markets, okay? So it's just like sometimes you cannot outbeat the market even though a market is strong, semi-strong. One of the stocks is Adani, okay? This rapidly growing conglomerate stock prices have witnessed meteoric rises, raising concerns about potential overvaluation and information asymmetry. Some argue that short-term hype and investor sentiment might be playing a larger role than fundamentals, deviating from the EMH assumption of rational price discovery. So the Adani stocks, they do not tend to follow the market norms properly. They get overvalued. In fact, you will noticing also not like during the elections results. Did you see the upward downward movement on Adani stocks? Okay, start even if you're not trading in the markets now. Going forward, just start reading business. Market articles or start observing markets. You learn a lot. Even I keep using practical examples in my classes. So you will also enjoy it when you see your practical concepts getting observed in news or something. So Adani stocks now they moved a lot. On the day of counting, they fell like anything, and then on the next day, when ND was able to prove its majority and the inclination to come the government, then it rose again. So Jay says, okay, I'll not comment on it, but yeah, that's what is said in the market. Image is only a theory. Everything works on emotions. Absolutely right. In fact, the recent events, it is a complete, you can just say that everything which happened, it was working on emotions. It was all on emotions. So yes, this is a theory and there are proponents and critics of it. But yes, just something that you need to know. Broad forward knowledge, but we have covered it over here. Okay. Now, I think we can wrap up the class. Okay, it's 12 o'clock. So we'll stop here. But make sure you revise the concepts. So normally now, I've not seen questions on EMH, honestly, at AFM level. But, just know it. I mean, I've not seen questions, but what type of questions could come is that they could give a scenario. And you are the finance manager have to comment on what type of information could affect the stock price, and they will give you that your market is a semi-strong market or a weak market, and then they will give you all these information are there in the circulation. Will it affect your company's stock price or not? That is the type of question which can come, but I've not seen questions per se at the AFM level. FM level, there are a lot of questions on this topic. AFM level, I've not seen, but you never know, it can come. All right. So everyone, we'll wrap up the class here. Study during the week. You can revise the notes, and if you get any doubts now, please note it down. And on next Saturday, when I start the class, now you can ask it to me. I will address it. Okay. Thank you so much for joining in. Bye bye, and take care of yourselves. Keep studying. Thanks a lot.